Friends, good morning. Friends, good morning to all of you. In fact, every day we have been having our programs in the evening, but not to break the continuity, we thought let's continue though it's Sunday. And I was just mentioning before some time our beloved speaker today, CAK Gururaj Acharya, has become our Sunday specialist. Last time when we wanted him to address on tax audit, it coincided on a Sunday. And yet again, when we wanted him to speak on Companies Act, it has coincided on a Sunday. So I welcome all the delegates who have joined virtually to take part in this concluding day of the 3-day intensive refresher course. Today, the topic coverage is acceptance of deposits and related party transactions. And I had an interaction with the speaker. He has promised to cover a lot of other ancillary things which will help the audit when we try to do this audit for the private limited company. And very importantly, today joining with us is our immediate past chairman of SIRC and chairman of the Corporate Taxes Committee, CA Joman K. George. We request you to share his thoughts and then we'll introduce the speaker. Joman, over to you.
Thank you, my dear Chairman Dungarchan Jain, Secretary Abhishek Murli, and the very learned speaker Gururaj Acharya. I always say he is Guru, he is Raja, he is Acharya. And he has been doing a very, I would say, very active role in knowledge dissemination in the last many years across the region and outside. Last year during my chairmanship, I remember we had done a lot of programs with variety of topics. That is corporate law, taxation is a reservoir of knowledge. Sir, thank you very much for your continued support to SIRC and its branches. The members are largely benefited. Extremely happy to have you this morning as well as a Sunday specialist, as the chairman said. On the last day, but a very important day of this 3-day virtual refresher intensive course on the Companies Act 2013, covering some of the very important areas of the enactment. This meeting is partly an outcome which chairman and secretary would agree, outcome of a corporate law committee meeting we had a couple of weeks back, where senior members like S. Ramakrishnan and including MPV said there is a need to revisit the Companies Act 2013, threadbare the provisions, because 56 Act we were so used to, we could quote sections and all those things. Even MPV and all that said we should revisit, we were surprised. If that is the case with experts like them, what about other members like you and me? So yes, we'll surely look at it. And in a short span of time, chairman and secretary organized this 3-day program. I'm here to make some very short introductory remarks about the topic. So I was just laying the backdrop in which we are sitting here together. Third day, the first day is we have now, the chairman should be happy, man. Sunday morning before 10:30, I've scored the century already and going great like Virat Kohli, 111 as of now. Great going. Yeah, congratulations. And also to Secretary Abhay, who's very specially invited me to make these introductory remarks this morning. So accounts and audit, yes, we covered on the first day, chapter 9 and 10. And then we moved out to discuss the loans and investments and private limited companies. Today, two very important topics: acceptance of deposits, which is having a lot of non-compliances because of poor understanding of the provisions. This is contained in chapter 5, as you can see, section 73 to 76A. And followed by that is the related party transactions, which you find in chapter 12, section 188, puts restrictions as well as prohibitions on related party transactions. And section 189 is the next important section, the register which is to be maintained. I'm not getting any topical here because we have the expert who has come with so many aces up his sleeve this morning. And listening to Gururaj has always been very enriching, I would say, feast of knowledge he would always provide. So extremely happy that SIRC could, in a short span of time, organize this program. Sunday or not, members are very keen to understand and apply the provisions of the law. And very important, I always say that chartered accountants, particularly in days of slightly lesser activity, the ideal time for learning, timelines have been extended. So not much of work pressure. We should revisit and reinvent some of the areas we have left out. I have been saying over the last many years, chartered accountants have unfortunately pledged the corporate law practice to company secretaries. But there are a lot of opportunities, lucrative opportunities. And ideally, if one partner can get IBC also, an insolvency professional, gel well the Companies Act practice and the company law practice, right from incorporation to making companies defunct, filing of annual documents, returns, all those things. There are a lot of opportunities in there. So therefore, we should not be closed. The profession individually, every one of us, and collectively, the profession should not be close to the idea of reopening because tax practice, one way or the other, we can see with impersonal, faceless assessments while fading out. So we should look at newer areas. And I think the younger members in larger firms, younger partners should essentially embrace corporate law practice, and there's a lot of opportunity in there. I'm sure that this would be only a beginning of a lot of programs which we would plan, chairman would plan. It would be my pleasure to support, to organize on the corporate law front. So this is a backdrop, and therefore with that, let me conclude once again, making one more this thing that the Companies Act 2013, any reading, this Leonard Specker would agree that we do not buy books now. Go to the MCA website. On the left-hand side, you have the e-book Companies Act 2013, which has the rules, the notifications, the effective dates, and so on. That's the only place where we can reliably read, because it is not yet settled. Even after 7 years, a lot of changes are being made. Keeping in mind ease of doing business ranking and all those things, a lot of changes are happening. So one has to keep track. It's a delegated legislation, 470 sections in 29 chapters. So rules should also be referred to at the relevant point. And therefore, with that, wish you all very, very, very happy learning. And one more good thing, I think I had sent a mail personally. SIRC's Corporate Law Committee, under the guidance of Chairman, I had initiated requesting the ministry to do an extension of the AGM dates through the Corporate Law Committee of our ICAI, which has been inter alia. A lot of people are represented, heard, and I'm sure that you are aware of the jurisdictional ROCs have passed orders under 96(1). So the due date of holding the AGM stands now extended to 31st of December, except for the AGM cases. Even where your GNL application was rejected or under consideration, all those would be covered. So every company is now required to hold AGM only by 31st December. That is a good news. Some more time for planning the audits, particularly within 15 days expiry, all those things. So wish you all the very best. Thank you, Chairman and Abhishek, for the opportunity. And Sir, Gururaj Sir, thank you so much for all your continued support. Convey my regards to a personal note, Amog also, his son and my daughter, they did BCom together in Bangalore. Hope he is fine. Great learning to every one of you. I have another function. I will stay tuned for some time. Maybe I may have to leave after some time, but I'll surely come back with the recorded version. Thank you so much. Great day.
Yeah, thank you, Joman. And as you rightly said, we will kind of have some sessions where more on Companies Act we are able to discuss, and probably you use the word revisit so that we are able to give more to our members. We'll do that. And with Joman himself being a prolific speaker, I think it's going to be easy for us to, touch on the topics which will actually require everybody's attention. So Abhishek, over to you to introduce the speaker and we take things forward.
Thank you. Thank you very much, Chairman. A very good morning to all the participants who have joined in today. Dynamic Chairman of SIRC, CA Dungarchan Jain, immediate past Chairman, CA Joman K. George, and of course the learned speaker of the day, CA Gururaj Acharya. I think Joman sir has given a very, very lovely introduction, and he set the tone for the event. And being a Companies Act expert himself, as Chairman very rightly said, listening to him talk about Companies Act is a real pleasure. And in fact, even in the council, he regularly shares updates and materials with us, which we use both in our firm and in our day-to-day practice. So he is the right person to give the kickstart for today's event. In fact, we had wanted him to inaugurate on Friday, but due to some commitment, he had requested he will join for today's session. But he rightly set the tone again, and I think his address will definitely be remembered. I now have the privilege of introducing our speaker, CA Gururaj Acharya, and he is a person we are all familiar with. His address just a few weeks back, I think last month we had done a session, a 3-day course on tax audit, where he covered on the impact of standards on auditing on tax audit. It's a wonderful presentation and we received excellent feedback. We always loved listening to him, and he's one of the few people who can attract our members on a Sunday morning. So we once again took his services today. So I have the privilege of introducing him. He hails from the temple town of Udupi, and he was brought up in the iron city of Bellary, and he is now settled in the knowledge city of Bangalore. He's a qualified chartered accountant, and he is presently a partner of his own firm in Bangalore, specializing in corporate finance, corporate tax, and company law. In fact, I must say, along with his wonderful knowledge, his academic prowess is something to be marveled about. He's the first rank in BCom in his university. In Inter, he held the 21st rank in CA. In final, he got the 10th rank in CA. In his CWA, he got the first rank, All India first rank in his Inter, and All India third rank in his final. In fact, he is a member of the Bangalore Financial Reporting Review Group, formulated by the ICAI. He is a director on the board of directors of State Bank of Mysore, a member of the Karnataka State Level Audit Advisory Board, co-opted member of the Expert Advisory Committee and the Committee on Accounting Standards for Local Bodies. He's an author. He's authored several books, including the very popular book of Internal Financial Control, a practical handbook on audit report as to what can go wrong. And he's a resource person eagerly sought by all India. We always love listening to him, and we have the privilege of having him with us today. This is only a brief introduction. I welcome you, Gururaj sir, and thank you for taking time on Sunday morning to be here with us and address our members once again. Thank you, sir.
Good morning to all of you. Thanks to the ever-smiling secretary of SIRC. I like your smile. As I told you, it is quite infectious. And then thanks to the dynamic chairman of the SIRC. And thanks also to the most knowledgeable immediate past chairman, Mr. Jayman K. George. In fact, when I was trying to give the right adjectives, the ever-smiling, the dynamic, and the knowledgeable, then I thought I can crisscross that to each one of you. I mean, I can say ever-smiling Dungarchand, then most knowledgeable Dr. Murli, and dynamic George, or the other way around, whichever way. Say all the three are quite knowledgeable, quite dynamic, and ever-smiling. I call them as, of course, leaders. Leaders they are, unlike me. You know, I sit only in a corner room, do my research, and come there, you know, once in a while before the people who seek for knowledge. But then you people are, of course, not leaders, and also doing the research and knowledge sharing in your own way. I mean, you are also specialists in the respective field. So I have coined a special term for people like you. You are learned leaders. So I'm so happy to be amidst the learned leaders today, because very few people, I mean, people who are learned generally don't take up leadership, and people who take up the leadership in the institute at least are not as learned as they are required to be. But then we have exceptions in all the three of you. And I'm so glad that I am sharing the, what should I say, the virtual space on screen with the three of you. So today my session, and I also would like to thank my guru, Sri Pannaraj, who is also the co-council member in the SIRC, who has been my source of inspiration always. And he has taught me accountancy when I was a student of CA in Bellary. You know, Bellary is a small town, so he was a very knowledgeable person even now. So I respect his knowledge and acknowledge his virtual presence. He said he will also join in some time. Having said that, so today's session I will be talking on two very important topics, which I would call it as most important, but probably from the chartered accountant's point of view, not seen as much as it should have been seen. I mean, maybe everybody concentrates on Chapter 9 and Chapter 10. As Jayman George talked about, entire Companies Act consists of 29 chapters. And if you see, the most important chapter is Chapter 9. I always have a fascination towards 9, the number 9. And that happens to be the highest number in the numerology. So therefore, it is a very sacred number also. And having said that, Chapter 9 is a chapter dealing with accounts. So I'm very happy that in the Companies Act, Chapter 9 deals with accounts. And Chapter 10, Dulkar, if you have to say, Chapter 10 deals with the most important chapter again, which is relevant to us, which is actually the captain's t-shirt number. So I would say that the captain of Companies Act in that sense is actually the auditor. And sometimes I get a doubt, the captain, should he not have been the director of the company? But then, you know, in the sequence of chapters, you will see that the director is coming after the auditor. Chapter 10 is auditor and Chapter 11 is on directors. Sometimes I blame that, but I mean, on the other hand, I think I am very happy the Tendulkar's t-shirt of number 10 is given to the auditor. Maybe in a way, like the Prime Minister said, that the signature of the chartered accountant is more precious than the signature of the Prime Minister. So that way, maybe the authors of Companies Act wanted to convey a point that the role of auditors is equally important, if not more, than the role of directors. I think to place that responsibility, they have made us the captain of the Companies Act, and we have to take it upon us to read in that particular, not only read, ensure that we convey this to our clients and they properly comply with the requirements in true letter and in true spirit. So that is how the entire Companies Act is there. And that session today, I had promised Dungarchandji that I will be not only talking on deposits and related party transactions, but I will also be talking about issue of share capital and significant beneficial ownership. But later on, I realized that 3 hours is not sufficient to talk about so many topics, because these two topics, I was told Chinnsamy Ganesan has structured this, and he has rightfully structured. Then I thought that if I talk about too many topics, it will look like I'm doing injustice to one of them. So let me spend 1.5 hours on deposits. When you may be surprised, is there 1.5 hours? Yesterday when I was talking about tax audit, only the changes provisions in, I think, Bengaluru branch, Pandaraj sent me saying that 3 hours you are talking only on the changes in tax audit provision. I thought that was too much. But then after listening to me, he said that went on like 3 minutes. So like that, deposits, I'll be talking for 1.5 hours, maybe slightly lesser, because related party transactions is a big chapter, which I will be again talking for 1.5 hours. So therefore, I may be permitted to talk about only those two topics which have actually been shown on the agenda sheet. So nobody will blame that, because that was only a secret agreement between me and Dungar to say that I will be covering more. But then although I made it public to emphasize the fact that these two chapters itself require more than 3 hours, but I will try to condense it and convey the message of whatever is there in these two chapters. And I call these two chapters as playing with the fire. The deposits. You may think that deposits having only 4 sections, as rightly said by George the Great, I may call him, only 4 sections dealing with deposits. But if there is something which you don't properly comply in deposits, it will be like playing with the fire. Similarly, and I think I scanned through the entire Companies Act, the highest amount of penalty, if at all, which is levied for a particular non-compliance, it is on the non-compliance of the Chapter 5 on deposits. So I will show you the details why it is spelled like that. And also the other important chapter which Chinnsamy Ganesan has rightly brought out for the syllabus today is the related party transactions. Related party transactions also to ensure that the people who are in the helm of affairs do not seek favors which would be at the cost of the majority shareholders, which would be at the cost of the shareholders or other, detrimental to the shareholders. This particular chapter 12 is there to protect the shareholders from the transactions, because when the people who are charged with the governance have the ability to do certain transactions which will benefit them, so they have brought in additional, governance mechanisms to ensure that they are not unduly favored and to the detrimental effect of the shareholders. And if you talk about deposits is the chapter on deposit has been authored keeping two important. Entire Companies Act itself is authored considering Sahara and Satyam, but the chapter on deposits is particularly considering Sahara and Satyam, because Reserve Bank of India wanted to say that the companies should not, because the moment the word company is there in the minds of the people, they think that there is no difference between a bank and a company. The gullible investors, I would say. So the gullible investors, to protect the gullible investors from the from giving the money to the company where they expect a higher rate of return than the bank, and then later on losing and blaming the government. So the entire chapter 4, chapter 5 dealing with these 4 sections are there to ensure that the gullible investor is protected. Sometimes it may look like it is an irritation to the company, coming in the way of ease of doing business. When look at this, an advance given by a customer is also alleged to be a deposit under the Companies Act if you keep that advance from customer for more than 1 year. So, I mean, such simple things which are actually done in the interest of business could also be called as deposits, calling for very harsh penal provisions, and also bringing the responsibility of the auditor where he has to sign the DPT-3. We'll have to sign a certificate every year to say what are all the deposits which have been collected by the company. And deposits are not deposits which is normally understood. Simple thing like share application money kept beyond 60 days will be deemed to be deposit. Like that advance received from customer kept more than 1 year could be deposits. So we will see all these things, but I wanted to just set the tone to say that these 2 chapters are the most important chapters of Companies Act, and that is why we will be dealing with that in greater detail. So now let me put on my presentation. And also I have told Dungarchandji that the way forward today will be based on question and answers. Any questions that you have, you may please post it as and when you feel like in the question and answer box. And I have requested Dungarchandji that whenever he feels tired of listening to me, to stop me and ask a couple of questions. That way I will also get a break and you will also get the break of listening to the same voice. And having a welcome change that way. So this is the overall syllabus which I am told very successfully covered for the last 2 days. So today my syllabus will be acceptance of deposits and related party transactions. How I will be approaching this particular two topics will be, what is that as a chartered accountant? As a chartered accountant, I will have to look in what are the various compliances required under these 2 chapters. And finally, if there is any non-compliance, how is it that I should report in my main audit report as well as in my CARO report? Because these 2 sections, these 2 chapters are very specifically, a question is there in the CARO to see if the section 73 to 76 has been complied with and section 188 has been complied with. And to answer that question, I mean, one can talk about just 1 hour for CARO covering 16 points. But then these 2 chapters itself, these 2 sections itself is a session for which we can talk for 3 hours. That is what we are doing now, so that we are having complete mastery on this particular subject at the end of 3 hours. And what is the role of an auditor in the statutory compliance? So this is the specific manner in which I proceed. But before I proceed, I wanted to give a gyan on one very important matter which I have been taking up of late. In the Hindu ritual, we have something called the Shodasha Samskara. We call that as 16 rituals that have to happen in the lifetime of a person, from starting with his birth up to his death. So let's see what those 16, what we call as the 16 rituals, or in Sanskrit it is called as Shodasha Samskara. Now it starts with Garbhadana. I mean, these are all conducted by the priests. I mean, Garbhadana is where the priest will invoke the blessings of the god for the at the time of marriage, invoking, saying that your marriage is holy and sacred, and let the child which is born to you be a very sacred, the most powerful child on earth. That is what we are seeking, the blessings of the god in the conjugation process. And then we have something called the Pumsavana, which is conducted during the pregnancy, between 2nd and 4th month, where just to ensure good health of the fetus and for the proper formation of its organs. And then there is something called the Simanto Nayana, when it's also called as Simantotsava, or the baby showers, what it is called in the normal language today, which is conducted around the 8th month of the pregnancy to protect the fetus, especially its newly formed mind, from all the negative influences, to stimulate the development of the unborn child's intellect. And then we have the Jatakarma, where the child's horoscope is written, ensuring that its future is blessed and divine. And then we have the Namakarana, the naming ceremony of the child. Nishkramana. What is Nishkramana? It's actually taking the baby out, baby's day out for the first time, normally taken out to a temple. And then we have the Annaprashana, where the baby is fed the rice for the first time, the first feeding of the solid food to the baby. And then the Karnavedana, the piercing of the baby's earlobes. And then the Chudakarna, where for the first time the baby's hair is cut. But each one of them has a ritual, and the priest will be there to perform the ritual as per the Shastras. And then the Vidyaramba. Then starts the most important thing of starting the education, where the child is sent to the Gurukul, or probably the child is sent for doing the articles under a chartered accountant in today's language. And then the Upanayana. So Upanayana is doing the sacred thread ceremony, initiating the child to the higher learning of the higher Vedas, that is. And then we have the Samavartana, and where he says, I have now completed my education, and I call that as the graduation ceremony. And then the Vivaha. So after the graduation, he is fit for marriage. And of course, his marriage takes place. And the Pancha Mahayagna. And during the course of the Grihastha, he has to do 5 great sacrifices daily to honor the rishis, that is the saints and the gods, the parents, the ancestors, the humankind and all created beings during his married life. And after the completion of his term, he has to quit the societal chains and go to the and have something called as the Vanaprastha, where he has to actually go to the Vana. That means he has to go to the forest, giving up all the worldly pleasures. And finally, it ends with Antyeshti, the final sacrament funeral rites. Now, this is the Shodasha Samskara in the lifetime of a person from birth to death, and normally conducted by a priest as per the Hindu rituals. Now, why did I talk about this? Just to tell you that we chartered accountants are the priests for the corporates. We have to do all these rituals, starting whatever we talked about from the conception stage to the birth stage, to the naming stage, right up to compliances which has to happen during the lifetime, and finally at the closure of the the Antyeshti of the person what we just now talked about. So like that, we have got not 16 rituals, but more than 16 rituals which has to be done in the lifetime of a company. So in the life cycle of the company, a chartered accountant acting as the corporate advisor or the corporate priest, if I may have to say, will have to go through all these rituals. So I will start that. This ritual will start with the incorporation documents. It starts with the naming ceremony, Namakarana if we have to call. But then today, Namakarana and what we just now talked about, Garbhadhana or the formation of the child or the formation of the company today is called as the incorporation, which can happen simultaneously through Spice plus Agile. So you can have the name of the company as well as the incorporation in one document, and within that you can do it, or you can apply Spice, get the name clearance first, for which you will have a 20 days time period, and thereafter you can go ahead with the company formation. We are following the second methodology because under the first methodology, if the name is not given to us, then all the documents will have to be redone. So first we get the name and then we do the company formation. And then you see I have formed 16 very important rituals which has to be performed, starting with immediately after incorporation, the company cannot start its business. Within 180 days from the incorporation, within 180 days from the date of incorporation, the promoters have to bring in the capital which has been subscribed in the memorandum of association, and he has to tell that I am ready for doing the business and file a document called INC 20A as per section 10A of the Companies Act. This has been extended to another 180 days because of COVID reasons from the date of incorporation. Then only you can commence your business and start doing any borrowings, if at all. Then we have to every year, whatever deposits the company has taken, that is my subject in proper today, for the money taken being deposits or not considered as deposits. Whether taken as deposits or not considered as deposits, the company has to file DPT3 every year by 30th of June. So this year, whatever filings we have to do, we have the benefit of Company Law Settlement Scheme, CLSS scheme, by virtue of which all the forms which have never been filed since inception to date can be filed before in the next 17 days, 30th of September 2020, by virtue of which you can get ahead without paying any additional fee and no prosecution and penalty for not filing the return. If there are any penalty and prosecution for not complying with the particular provision, that will still take place. Then MSME, dues of more than 45 days to MSMEs has to be intimated to the registrar in 2 half-yearly returns by 30th of April once and 30th of October. Then the charge creation documents, I call that CHG1 and CHG4, both the charge creation and the satisfaction. Please note, most important documents. If you don't file this charge creation documents, CHG1, within 30 days, in the next 30 days, you can file with additional fee. 30 plus 30, 60 days. If you don't file within 60 days, there is another 60 days, the last 60 days from the date of creation of charge with the banker or the lender. You will have to file it in the last 60 days. I call it as the last 60 days. If you don't file it for the first 30 days with the normal fee, next 30 days with the additional filing fee, then the last 60 days, you will have to file with the additional fee plus an ad valorem fee linked to the amount of loan that you have. So there will be a percentage of the loan will be charged as a filing fee, a very serious thing. And after 120 days, you can never file this document. You can never file this document unless you go through a tribunal and get a special permission to file it. So whenever there is a charge creation, we are advising our clients that you have to file it as early as possible. So that is about charge creation. Then appointment of auditors by the company within 15 days. ADT 1 has to be filed. Resignation of auditors within 30 days. ADT 3 has to be filed. Financial statements, all of us are aware, AOC 4 has to be filed within 30 days from the date of AGM, that is. Then MGT 7 annual return within 60 days from the date of AGM. Return of allotment for allotment of shares. Changes in share capital. Resolution under section 117. Resolution under section 117 calling for filing of MGT 14. MGT 14 was initially required for every sneezing of the company, for every act of the company. But today, the rigors of MGT 14 has got reduced. I will take you there to say what are all the important documents, what are all the important transactions calling for filing of MGT 14. Then we have the change of directors. The change of directors, DIR 12. Very interestingly, DIR 11. Whenever there is a change of director, originally form 32, what we used to say, is now coming in as DIR 12, and that is done by the company. In fact, when the director resigns, he will write a letter to the company saying that I am resigning from, let us say, 13th of September. And if the company does not file the DIR 12 accepting my resignation, then I have been given the option of filing the DIR 11. Originally, DIR 11, both I should have filed as a resigning director and the company should have filed DIR 12 accepting the directorship. Then for ease of doing business, they have reduced one form. DIR 11 is not required unless the director voluntarily wants to file, which normally gets filed when he feels that the company is not filing the DIR 12, but I want to inform the world at large that I have ceased to be a director of this particular company. So therefore, any action done from today, I will not be responsible. If I want to make it known to the public at large, then DIR 11 I will file, which is an option within 30 days of my resignation. Then MR1, return of appointment of managing director or whole-time director, not applicable to private limited companies. INC 22, usually done at the time of incorporation or within 30 days of incorporation, which is the intimation or change of registered office address. And then the most important document, significant beneficial ownership of the company has to be intimated. What is the significant beneficial ownership? In short, any shareholder not being an individual, being a non-individual who is holding, and finally, if the company is holding the shares or a partnership firm is holding a shares or LLP is holding a share or a trust, non-individual is holding a share, I would like to go to the end to find out who is that shareholder who is the individual. Let us say in my company, the shareholders are a private limited company and a partnership firm. In the private limited company, I would like to know who are the shareholders. If it is again a trust and a partnership firm, I would like to go beyond and find out in that trust and partnership firm who are the partners. So I will go until to find out who are the individuals behind the ownership in my company, such that I would like to find out, are there any shareholders, individual shareholders who is holding more than 10% shares in my company, either singly or jointly. So that is in short the concept of significant beneficial ownership. I would have named it as significant individual beneficial owners. That is how I would call it. Significant means not 20%. Normally significant is understood as 20% in accounting standard parlance, but here they have brought it down to 10%. So significant individual beneficial owners of the company holding more than 10%. I will go and pierce the non-individual wheel and find out who the individual shareholders are, and I will have to file a Ben 1. After collecting a Ben 2 from such shareholders, the company has to file Ben 1 within 30 days from the date of receipt of this Ben 2. So beneficial interest being, all these things in front INC 20 to Ben 1, Ben 2, I have shaded it in a different color to say that these are the most important 16 rituals which the company has to perform. I have shaded it just to say the Shodasha Samskaras for the company, and beyond that, beneficial interest, if the registered owners are different and the beneficial owners are different, that normally happens in a wholly owned subsidiary. Let us say in a wholly owned subsidiary, 100% of the shares have to be held by one company, but technically there should be two shareholders. So the registered owner is only there as a nominal, just for the sake of name. So that person should file with the registrar of companies, with the company, saying that I am the registered owner, and the company, the wholly owned subsidiary has to file with the subsidiary company saying that I am the beneficial owner. These two documents will together be filed in MGT 6 by the subsidiary company to say that the one is a registered holder on holding shares on behalf of the beneficial owner. So that document gets filed in MGT 6. Address other than registered office, transfer of money, IEPF, very important, application to ROC, submission of documents to ROC, return of AGM, application for strike off. So if the company's life cycle has come to an end, the Antyeshti happens with the filing of application for strike off, which has to happen within 30 days from the date it decides to wind up. So this is the major samskaras. Having said that, I said I will be covering one important document, MGT 14, where all it has to be filed. All special resolutions have to finally, once it is passed, will have to be informed to the ROC through MGT 14. Then resolutions agreed to by all members. If for any reason there is a resolution which has to be passed by all the members, then also that particular resolution has to be filed. Then it is more than a special resolution. So therefore take it that way, that it has to be filed. Then board of directors resolution relating to appointment, reappointment, renewal, variation of the terms of appointment of the managing director, resolution agreements which have been agreed to by any class of members, voluntary winding up of resolution passed by the board of directors under section 179 subsection 3. So we will see what that is, and any other resolution by agreement placed in public domain. So anyway, G is not applicable to private limited companies. So any other resolution agreed or placed in the public domain. The penalty for non-compliances, that is not filing the MGT 14, apart from the additional filing fee, the company will have to pay 1 lakh to 25 lakhs as penalty, and the officer in default will have to pay a penalty of 50,000 to 5 lakhs. There are certain samskaras, additional samskaras for companies being non-public documents. What we saw then was public documents, like the active for companies to be filed in the individual capacity, the DIR 3 which has to be filed as and when the director, to be filed by the director, to be filed DIR 3 KYC, which has to be filed every year. In fact, very interestingly, if you see the shaded portion in the right side, you will see that now annual filing is not only AOC 4 and MGT 7, DPT 3 is also an annual filing. MSME form is also an annual filing if there are any dues. And then this DIR 3 KYC. DIR 3 KYC is also a form which has to be filed every year before the 30th September. and then cost audit report, removal of auditor, application of documents with central government, most important ones I have listed there. I'm not taking further. Next, I go into my specific topic, deposits. Dungarchandji, shall we proceed with this, or are there any questions?
There are questions. Shall I ask? There are some.
Just take 2 questions. Just take 2 questions, because whatever I dealt with now is only setting the tone.
Okay. Okay.
Now, the question pertaining to this subject is what we should take, but any questions you can take here.
Yeah. The first question is, what is the responsibility of an auditor on advances not passed through company current account and books, which are beyond a period of 1 year?
Yeah, I will take that question a bit later on, because not everybody knows this. I just told about that as a passing remark. So then if there are questions like that, let me just complete this and then we take up, unless there are any general questions.
Other than that, is it mandatory to file MSME return even if it is nil? And
That's a good question.
How to find out that the creditor has MSME if not mentioned in the invoice?
Yeah. See, I think it is a responsibility of the company to take at the time of placing the order itself, whether he's an MSME or otherwise. So all the companies today are taking that particular document, and I wish that the moment I put the PAN, I'm sure it will come now. We have told this to the ministry. I think an SIRC also can send suitable representation to say that the moment I put a PAN of a particular entity, today so much of exchange of information is happening between the MOMC. You know, MOMC is Ministry of Medium, Small and Micro, Small and Medium Enterprises. That is in as an acronym called as MOMC, just like Mausi Dungarchandji. So just as you have Mausi, we have MOMC. MOMC is the Ministry of Micro, Small and Medium Enterprises. So that is talking to the income tax department to find out, because today the investment criteria on plant and machinery and the turnover is very surprisingly coming from the income tax department. The moment I start filling up the form from the income tax department, what is my written down value of the plant and machinery as per section 32? So that gets in automatically filled in the Udyam Aadhar when I make the filling, and that, so therefore when it is getting filled up, maybe they're talking to each other. The moment I put the PAN, I should know whether he's a micro and small industry. So first of all, there are 3 categories: micro, small and medium enterprises. But the benefit of this 45 days, we must understand, we have to pay to such an entity who is a micro and small supplier, not medium. Medium is not covered. Only the micro and small enterprise, I have to pay him within the agreed period, which shall not be more than 45 days. Also for MSME form, as I file with the ROC, it is only showing dues of more than 45 days. So people think that I have to pay him up within 45 days. But the fact remains that if I have promised to pay him as per the agreement in 15 days, I shall pay him in 15 days. Otherwise, let us say if I promise to pay him as per the contract in 60 days, then I have to pay it in 45 days. So a period which shall not be more than 45 days is what is told in the MSMEDA Act. Very interestingly, this MSMEDA Act in section 23 says that if you don't pay this within the agreed period or 45 days, then you shall pay to such a vendor who is a micro and small enterprise, interest at 3 times the bank rate. At 3 times the bank, you shall pay him, even if the contract states otherwise. Having said that, Section 23 of the MSMEDA Act, which is now told in the tax audit report also, where the tax auditor has to mention this, says that this interest which is paid to the MSME vendor shall not be allowed for income tax purpose. Shall not be allowed for income tax purpose. Now the question that is asked is whether the MSME form has to be filed even if I don't have dues. The answer is no. We don't have to file it if there are no MSME dues. And very interestingly, this MSME form does not have a filing fee. It does not have a filing fee. The second question is, how will I know that particular person is a micro or a small enterprise? We have to get it. We have to, what should I say, proactively get it from the vendor to find out whether, if not tomorrow he supplies it and I think that he is a non-MSME and given the payment after 90 days, tomorrow, the moment he says that he is MSME or somebody else says that he is an MSME, I will have to provide for that 45 days interest. So that is the risk that I will be taking. So please ensure to collect it, take undertaking from him if it is not there in his invoice, or proactively send him a letter saying that please inform us. If you don't inform us within 15 days, we take it on record that you are not a MSME. So that is the way we proceed further. Yes, Dungarchan, proceed.
Yeah, I think we'll take other things later.
Sure. So we come to the, why is this chapter the most important chapter, chapter 5 on deposits? Because specific question on this is asked in CARO. And why is it asked in CARO? Because they want to, as I told you, the deposit chapter 5 is so written as though to protect the gullible investors. Reserve Bank of India has told, that's why the word Reserve Bank of India comes whenever we talk about deposits. In fact, I was a director in the board of State Bank of Mysore, and we had a Reserve Bank of India director. And at that time, in 2013, when the Companies Act came, he was telling me, the Reserve Bank of India director told me that these provisions, 73 to 76, was inserted at the behest of Reserve Bank of India. So they are the ones who told that they are the regulators for bankers, where the deposits are collected. So they want the corporate MCA as a regulator, along with the Reserve Bank of India, to control the deposits that are done in the hands of the companies. So to protect the gullible investors, the auditor also has a role to play to say whether all the provisions as enshrined in the Companies Act have been properly complied with. If not, I have to report the non-compliance so that the MCA can take, or Reserve Bank of India being the regulators, can take suitable action against the company. Now, if I as an auditor am not aware of this provision and I don't report it properly, maybe I will also be considered as a part of the non-compliance. I will also be considered as an accomplice to this particular crime, and maybe I will also have to suffer. So therefore, thanks to SIRC for focusing on this particular chapter. Otherwise, only two clauses of CARO which we are talking about. What is the question that is asked? In respect of deposits accepted by the company or amounts which are deemed to be deposits, whether the directives issued by Reserve Bank of India and the provisions of 73 to 76 or any other relevant provisions of the Companies Act and the rules framed thereunder, where applicable, have been complied with. Now, very interesting, the words in red is inserted in CARO 2020. Before 2020, the struck off portion in black was there. That means for the 2016 CARO, which we are signing for the financial year 1920, the question is something like this. In case the company has accepted deposits, whether the directives issued by RBI and 73 to 76 and the rules thereof have been complied with. Now, we have to understand why they have struck off the word and inserted not only the accepted deposits, but amounts which are deemed to be deposits. So from 2020 onwards, I should talk about not only deposits accepted as such, but deposits which are amounts which are not taken as deposits, but are deemed to be deposits. For example, just now I told you, advance received from the customer is never a deposit. It is a normal advance. Because deposits, as we normally understand, deposit means amount given by the depositor, Let us understand the succinct difference between deposits and loans. In the case of loan, the borrower goes and makes an application. At the behest of the borrower, the lender lends. In the case of a deposit, the depositor is going at the behest of the depositor for the benefit of the depositor, because he wants interest or for some other purpose, he is going and giving. Now, in the case of advance from customer, the customer wants some product from me and therefore he is giving me the money. Certainly it is not deposit. But if this advance is going to be there with me for more than 365 days, then that deposit, that amount which I received will be deemed to be deposits, So we will see that deposits deemed to be deposits. In fact, earlier also this section was there and we were supposed to inform through this particular clause. But now, because deposits included deemed deposits, but now the question has been what was implied has been expressly asked in the CARO question. So in respect of deposits accepted by the company or amounts which are deemed to be accepted, whether directives are RBI and the provision of 73 to 76 or any other relevant provision of the Companies Act and rules thereunder have been complied with. If not, the nature of contravention should be stated. If an order has been passed by CLB or NCLT or Reserve Bank of India or any court or any other tribunal, whether the same have been complied with or not. So that is the question which we are supposed to answer. So I am dealing this chapter from the point of view of those auditors who are required to answer this. And in view of, I'm also taking on this particular explanation of this provision chapter for those chartered accountants who want to practice in the field of company law. For them, it is a compliance. For the auditors who don't want to do the company law practice, for them, it is just to understand what compliances have to be done and whether it is done. So for me to answer this particular question. So first thing we have to notice, this particular chapter, Companies Acceptance of Deposit Rules, and Chapter 5 is not applicable to banks, banking companies. There is a difference between a bank and a banking company. Now, what is the difference? A bank, all banks are not banking companies. Now, for example, State Bank of India, State Bank of Mysore, where I was a director. I was a director in the bank without having a DIN, because State Bank of India is not registered under the Register of Companies. So for me, Companies Act will not be applicable. But Companies Act says there are certain provisions of the Companies Act which also applies to banking companies. That's a different subject. But where is the State Bank of India formed? State Bank of India is formed under State Bank of India Act, State Bank of India Subsidiaries Act. Now, Canara Bank is formed under the Nationalization of Banks Act. So all that 18 banks and plus 6 banks, whatever were done under the Nationalization of Banks Act, not under they were not formed under the Companies Act. Now, banking companies in particular means, let us say the Axis Banks, the HDFC Bank, all these are banking companies. So it is definitely not applicable to banks and banking companies, not also applicable to a company which is registered with Reserve Bank of India as non-banking finance company and a housing finance company. And such other companies as the central government and Reserve Bank of India may specify. That's the first thing that we need to note. Next, I proceed further. I will talk about these 4 sections in a colorful manner. Because please understand, if you understand colors, it is easier for you to understand the various provisions of the Act. Chapter 5, Acceptance of Deposits by the Companies. That's the name of the chapter. And deposits have been defined in section 2, subsection 31 as deposit includes, so first of all, it's an inclusive definition, any receipt of money by way of deposit or loan or in any other form by a company, but does not include such categories of amounts as may be prescribed in consultation with the Reserve Bank of India. So let me read it once more. As I told you, deposit does not mean only deposits. Deposit means, I told you, the company is, from the point of view of the company, deposit means the depositor is coming and giving that money to me. That is deposit. Loan means the company is going ahead and seeking that loan. So both the deposit given by the depositor and the loan taken by the company are both called as deposits, or in any other form. In fact, it is like saying it's open-ended. In fact, the focus there is receipt of money. Any receipt of money will be a deposit, which means any receipt of money will be a deposit by the company. Now, does the share capital become a deposit? But does share capital become a deposit? The answer is, if the money collected as share capital is not allotted to the shareholder within 60 days, yes, it becomes a deposit. The moment it gets allotted as shares, then it will not be a deposit. So one has to understand like that. I will go further, but I'm just giving you a thought process there. Deposit includes any receipt of money by way of deposit or loan or in any other form by a company, but does not include such categories of amounts as may be prescribed in consultation with Reserve Bank of India. So there is something called deposit, there is something called deemed deposit, and there is something called exempted deposits. So, but does not include such categories of money or amounts as may be prescribed in consultation with Reserve Bank of India. These exempted deposits, if you come below, are given not in the Companies Act, That is why as may be prescribed. Whenever the Companies Act says as may be prescribed, you shall go to the rules and look into that. And very interestingly, whenever the Companies Act says as may be provided, that means provided as a schedule. So as may be provided means provided there are 7 schedules to the Companies Act. You will have to go and see the schedules for that particular provision. But whenever they say as may be prescribed, you will have to go and read the relevant rules. So in the case of Companies Act, the exempted deposit, deposits which are not categorized as deposits, in consultation with Reserve Bank of India, the MCA has formed a rule called the Rule 21C. That is the money collected which is not in the nature of deposit. I call that as the exempted deposit. So we have how many types of deposits? We have deposits. Under them, we have a classification of actual deposit and deemed deposit. And then we have the exempted deposit. So this deposit is what I may call as blue. I mean, I have complied with all the provisions and collected the deposits. So that is told in the colorful blue. I will talk about blue a bit later on, where I have complied with all the provisions of the deposits provisions and I have collected deposits royally. So that is deposits. Then deemed deposit means that which is actually not considered as deposits. Advances are not considered as deposit, but the moment they breach the 1 year, then they are also deemed to be deposits. So that will also be considered as blue. So there is a green deposit, there is a blue deposit. And green amount, I would not say they are not deposits, but they are exempted deposits are called green. Deposits which are considered as deposits and deemed deposits are called blue. And look at this, amounts which are collected as deposits, not complying with the requirement of Companies Act, are the bad deposits. I will call that as red deposits. So red deposits. So you have a green channel, no problem. Blue channel, which you are saying that they are deposits and I've complied with all the requirements of the Companies Act, I'm calling that as a blue channel, no problem. I have to comply with a lot of provisions. We'll see what the provisions are. And very interestingly, we have the red channel, which means they are actually taken as deposits, not complying with the requirement of the Companies Act. So therefore calling for penal provisions and prosecutions. So now, if these are the colors, let me go through the sections particularly and the rule. Section 73 starts with no company shall accept deposits which are not in compliance with the Act. So it prohibits acceptance of deposits from the public. Every company is prohibited from taking monies from the public unless it comes under the criteria of Section 76. We'll see that. So acceptance from members, and Section 73 also says one is public, one is members. So members means shareholders. Can I take monies from my shareholders? That says acceptance from members is okay, subject to certain conditions. So this blue deposits can have a 2 category. I have taken it from my shareholders, or I have not taken it, I've taken it not from my shareholders, which means I've taken it from public. So acceptance from members is okay, subject to certain conditions under Section 73 subsection 2. So we will see what the conditions are. Provisions not applicable to banks, NBFC, HFC and central government specified companies. So 73 is clear. We'll have to see what those conditions are when I have to accept it from the members. Section 74. Section 74 has got a limited life. Now, in fact, that Section 74 does not have a life at all now. Why do I say that? Repayment of deposits accepted before the commencement of this Act. If you remember, Section 58A of the Companies Act 1956 was less harsher. It was not applicable to private limited companies. It was only applicable to public limited companies. Now, this particular chapter is applicable equally to private limited companies. Although there are certain relaxations given to private limited companies, which we will see, but the entire chapter in totality applies. So if the private limited company had taken an exempted deposit in 1956 Act, which has now become a red deposit or a blue deposit, I will have to refund this amount within 3 years. That is what it says. No grandfathering, had to repay within 3 years, else seek permission for extension from the National Company Law Tribunal. But had to file within 30th June 2014 a form called DPT4, which we have to file every year. Even now, giving details of deposits. Else, severe penalty. How much was the penalty? Company had to pay 1 crore to 10 crores, and officers in default have to pay 25 lakhs to 2 crores and 7 years imprisonment. So one of the highest penal provisions for not complying with the requirement of repaying within the due date. Section 75 talks about if the company has intentionally collected with the intention of defrauding the gullible investor, then in addition to the penalty as told in section 74, if the intention is there to defraud, which can be proven, officer in default not only has to pay penalty and sit in the jail, he has to make good the losses or damages which may be incurred by the depositor. So that is the implication if it is fraudulently taken. What is section 76? 76 deals with acceptance of deposits from the public by certain companies. So we talked about, yes, from the public, certain companies, mostly only public limited companies and government companies and public limited companies. Section 76, deposits which can be taken other than from the public, other than from the members, other than from the shareholders, that is from the public, can be taken only from public limited companies. Public and public, you see this. From the public, deposits cannot be taken by a private limited companies. So only by eligible public companies. So not by all public companies, only if they have the eligibility. What is their eligibility? Their eligibility is told as net worth should be more than 100 crores or turnover should be more than 500 crores. And not only this is the first criteria. Either their net worth should be more than 100 crores or their turnover should be more than 500 crores. And they have to comply with a whole lot of conditions. We will see what those conditions are. If you don't comply with 76, there is a huge penalty, punishment for contravention of section 73 to 76. 73 to 76, if there is any non-compliance, originally it was not there, but inserted Wide Amendment Act 2015, the same provisions what was there, company to pay 1 crore to 10 crores, 25 lakh, officer in default to pay 25 lakhs to 2 crores, because that penalty what is told in 74 is only for the deposits, which amounts collected in 1956 arena, now becoming deposits which are to be repaid in 3 years, which you don't repay, that penalty of section 74 was applicable. Now 76A says the same penalty as in 74 will also be applicable if you have collected any deposits and not complied with the provisions as told in this particular chapter. Originally not there, but inserted Wide Amendment Act 2015. So we know blue deposits, that means from the members and from the public complying with certain conditions. Public limited companies only can take it from the public, private limited cannot take, that is blue. Green deposits means we will see Rule 21C. And since it is a workshop, this is a workshop on Companies Act. I think that everybody is sitting with a pen and paper, unless they are watching a television and also watching this particular program. Having said that, workshop means you should sit with pen and paper. You must write down this Rule 21C is the blessing or the saving grace for the company, what all that can be monies collected, yet being the safe zone. So I call that a green channel. If you don't comply it and it is not a blue deposit or not a green deposit, every money collected can be leading to a penal provision of 1 crore to 10 crores on the company and 25 lakhs to 2 crores on the officer in default, further leading to a imprisonment of 7 years. And if it is fraudulently collected, repay to the person who has incurred the loss, the actual loss amount itself. So that is the harshness of this particular provision. We've already seen the penal provision, reiterating that in a better format. Punishment for contravention we have seen. Damages may be claimed. This is a point I wanted to, I inserted for this session today because I'm talking to the auditors. Damages may be claimed through class action suit under section 245 by the requisite number of depositors. Earlier each depositor had to file the case. Now a group of depositors, if they feel that they have been cheated, they can file against as a class against a particular class. And that class against could also include auditors. That's what I wanted to say. If the auditors have not reported the non-compliance in a particular thing and they felt that everything has been properly complied, even the auditor could be a person who can, against whom the class action suit can be levied under section 245. By requisite number of depositors, if company's affairs conducted in a prejudicial manner against the company or against the auditor or the firm of auditors for improper, misleading information in the audit report. I mean, this is not my word. Please, I'm sure all of you are sitting in your, a comfortable place with a paper and pen because it's a workshop. Also open up the Companies Act section 245 and you will see exactly these words, maybe in certain boring words. I mean, I've tried to make it interesting by putting in bold and colors and underlines and things like that. So against the company, against the auditor or firm of auditors for improper or misleading information in the audit report, against the expert, advisor, consultant, or any other person. So please ensure that the reporting in CARO is proper to ensure that I am protected at the end of the day. Penal provisions of, look at this. There is something called, all of you must have heard last year, URD, that is banning of unregulated deposits. There was a banning of prohibition of Unregulated Deposits Act, which came out. Ordinance shall be in addition to, if there are any penal provisions told in that particular act, that will be in addition to and not in derogation of the provisions of any other law for the time being in force. There could be additional penalty as told under that particular law also. So let me go into the explanation of the various conditions and what are the various green deposits, blue deposits, and red deposits. So again, I have structured it for easier understanding in the form of a chart. Money received could either be a green deposit or a blue deposit. So green deposit means I have to look into Rule 21C. Blue deposit means deposit which are deposits by complying with the rules. I could either take it from the members or from the non-members. So from the non-members, if I'm taking, it should be only by an eligible public limited company. Eligible public limited companies can take it from non-members. And from the members, a private limited company can take it or a public limited company can take it. While a public limited company can take only up to 35% of the net worth. In the case of a private limited company, there are certain exceptions A to E, which I will talk about. They can take, there are certain conditions which they have to comply, but there are certain exceptions also, up to 100% of the net worth by all companies, and any amount. That means without any conditions, a private limited company can take it from the members beyond their net worth of 100%, provided three conditions are complied with. The three conditions are, in this private limited company, this private limited company should not be an associate or subsidiary. That means I should not have a holding company or an investor company. Holding company or a investor company. Let me tell you one very interesting thing. What is a holding company? Maybe I can ask this question to Abhishek. Abhishek, are you there? Or Dungar? I mean, maybe any one of you, I would like to just take a pause to ask you a particular question. To ask, yes, that if I am holding shares in your company more than 50%, then your company is called subsidiary company and I am called the holding company.
Correct.
I am called the holding company, and the company in which I am holding shares of more than 50%, you are called a subsidiary company. The next question is, if I am holding, if I am holding more than 20% and up to 50% in your company is called the associate company.
Correct.
Associate. 20 to 50, you are an associate. Who am I? Who am I? Until 2017 Amendment Act came, I was considered to be an associate only. I mean, both are associates. But now I have been given a specific name called investor company or venturer company. So that is a new terminology which came in section 2 subsection 76, where they defined related party to say I am a investor company, or I am because I am not a holding company. To be a holding company, I should hold more than 50%. Okay, if I am holding more than 20% but up to 50%, you become an associate. But I had no name, so I was a nameless. So therefore, now they have named me as investor company or venturer company. So that's the point I wanted to say. So I should not be, if I have to get any amount more than 100%, then I should not be an associate company or a subsidiary company. I should not have a holding company, and I should not have an investor company. That's what I wanted to say. And borrowings from banks, financial institutions, and body corporates divided by paid up capital should be less than 2 or less than 50 crores. any one of them breaching, I will not be complying with this condition. So therefore I go to 100% net worth. No default in repayment of such borrowings. So this chart is very self-explanatory. So I will proceed further. If it is neither a green deposit nor a blue deposit, then still you have collected money, then it will go under the red circle under contravention. It will go under the contravention where the penalties have already been discussed. So let me now talk about what the green deposits are. What the green deposits are. Rule 2.1c. I have tried to, in fact, Rule 2.1c, if you look into the rules, it runs into 6 pages. I mean, it runs into boring 6 pages, but I have tried to condense everything and bring it in one slide. There are about 18 classes of money which can be taken, including its subclassifications. 18 headings under which you can take, which will still be considered as not a deposit. Money taken, but it will not be considered as deposits. Let us see what they are. Any amount which I have taken from central government, state government, local authority, or local statutory authority is not considered as deposits in the Companies Act. Any amount which I take it from any foreign person, either as share capital or as loan or as ECB, provided it complies with the FEMA regulations. It complies with the FEMA regulations, then it will not be considered as deposits. So I have to go and see the FEMA. Under FEMA, if it is good, then it is good for Companies Act. Next, any loan or facility which I have taken from the banks, banks include banking companies, then it was considered as green deposits. Loan or facility from public financial institutions is also considered to be green deposits. Any amount collected through commercial papers, complying with the rules thereof, is considered to be green deposits. Intercorporate deposits. Very interestingly, the word used is not intercorporate deposits. Any money taken by the company from any other company. Any money, please, this word is very important. Any money collected from any other company, okay, is also any amount received from, that is a heading, from any other company. Any money collected from any other company is also considered to be an exempted deposits. Share application money collected up to 60 days is considered as good. After 60 days, if you are not allotting, you have been given 15 days window by which time you have to refund. If you don't refund within 15 days, then it will be considered as deposit from the date you collected it. So that is how the provisions are. It is not only share application money, it's securities application money, equity shares, preference shares, or debentures or whatever. Unless the securities are allotted within 60 days, it is good enough. Beyond 60 days, it becomes a red deposit. Directors, any amount collected by directors. This is very interesting. Any amount collected by directors when they were directors. Now, I mean, if I have collected money from Dungar Chand and after 1 year I make him a director, then it is wrong. If Mr. Dungar Chand was a director of this particular company and at the time of giving that money, he was a director, it is good enough. After 1 year, he has resigned and left, but the money was there. Then also it is considered as green deposit. Very interestingly, let me reiterate, saying that the deposit given by the director when he was a director is considered to be green deposit. Even if he subsequently resigns, that amount continues as an exempted deposit only. And very interestingly, I have marked it in yellow. Relatives of directors in the case of a private company is also considered to be exempt. Relatives, any amount given by the relatives of directors is also considered to be exempt deposit. There are, who is a relative has to be seen, and very importantly, subject to declaration. What is a declaration? The directors and the relatives have to give a declaration to the company that the money which they have brought into the company is not from anybody else. It is not a borrowed funds. It is their own funds. That is a declaration that they have to give. So only if they give this declaration and they are directors at that point in time, or they were relatives of the directors at that point in time, they were relatives of the director and the director was a director at that point in time, then the money given by such a person is considered to be exempt. Now, who is a relative? This I have already, I always keep telling, in the case of Companies Act, direct relative means aju baju, aage piche, upar niche for income tax purpose. Aju baju is husband and wife, Aage piche is brother and sister. Upar niche means lineally ascendant and lineally descendant. In the case of in Income Tax Act, this is the definition. Section 2, subsection 41. If you see, I have given below. Section 2, subsection 41 of the Income Tax Act is that particular definition. But the definition under Section 2, subsection 77 of the Companies Act is Aju Baju, Aage Piche, just upar, just niche. That means lineally ascendant and lineally descendant are not my relatives. All lineally ascendant. Just upar means mother and father. Just niche means son and daughter. Now, because they removed grandfather and grandson, they have brought in two more classification: son's wife, that is daughter-in-law, and daughter's husband, which means son-in-law. I think on the tax audit session also I spoke about this. Son's wife is son, daughter-in-law. Which law? I mean, I wish I could see somebody on the screen. Then I would say daughter as per company law. So daughter in company law, daughter-in-law, son in company law, son-in-law. So that is what is told in the Companies Act as a definition, and they include stepsons, stepdaughter, stepsister, except stepdaughter. I mean, very interestingly, stepdaughter is not considered as this thing. I have a logic for that, but I don't want to waste the members' time in explaining that particular logic. So relatives is to be seen from the Companies Act. Relative is to be seen from the Companies Act as husband and wife, father and mother, son and daughter, brother and sister, daughter-in-law and son-in-law. Now, very interestingly, if my grandfather gives a loan in a company in which I am a director, that will be considered not as an exempted deposit. Similarly, my grandchildren. So because the relatives are restricted, so that's how I have to see. And both of them have to give a declaration that it is out of their own funds. Now, issue of debentures. Issue of debentures is considered to be green category, provided they are either fully secured, or they are fully convertible, within 10 years, or they are listed debentures. Only these three type of debentures are considered to be green channel. So any amount collected from the employees is considered to be not a deposit up to 1 year, salary. I mean, let us say a person's salary is 1 lakh per month. So if I have collected from my employees up to 12 lakhs as a security deposit, then that is not considered to be that is considered up to 12 lakhs is considered to be a green channel deposit. Non-interest bearing and held in trust. Now this is one very interesting heading. I mean, the section 11 heading is any non-interest bearing. If somebody came and told me, Acharya, please keep this in your company, don't pay me interest, keep it under trust with you. And I don't know who comes and gives it like that to a company, but anybody if comes and gives it could be considered as a green channel. So can this be a planning in all those companies where you have collected from somebody and you don't want to call it as a red deposit? This could also be a parking space, provided you are not paying interest. But you have to take a letter from the other person that it is to be held with you on trust and don't pay me interest. So in that context, section 11, point number 11 can come in. So point number 13 is unsecured loan from promoters, if and only if stipulated by the banks. Now, sometimes when I go in for a bank loan, the bankers will tell that you have to get in a margin money of, let us say, 25%. That 25% which I bring in as a promoter, the difference between director and promoter is, I mean, the word promoter has been defined in section 2, subsection 69 as who has been named as such in the prospectus, or is identified by the company in the annual return referred to in section 92, or who has control over the affairs of the company directly or indirectly, whether as a shareholder, director, or otherwise. Whether as a shareholder, not being a director, he is the one who has promoted this particular company, or in accordance with whose advice, directions, or instructions the board is accustomed to act, not in a professional capacity. That is how they have defined promoter. Promoter means we generally say founder, or any person who steps in the shoes of the founder is a promoter. In the colloquial sense, he could be a director or other than director also. That's the first point. And if this money is brought in because the bank is telling in the sanction letter that it has to be brought in as a margin money, then he can bring in without the declaration. So the difference between item number 8 and item number 13 is, in 8 it should be only from director. In 13 it can be from a promoter who need not necessarily be a director. And another important change is, in item number 8, when he brings in as a director, he has to bring in a declaration saying that it is not from borrowed funds. But under item number 13, he will say, even if it is from borrowed funds, without a declaration, he can bring in this money. Accepted by Nidhi companies. And point number 12 is very elongated. That's why I had to finish off for the purpose of cutoffs in the presentation. 12 is very big. Any amount received in the course of or for the purpose of the business of the company as advance from customers up to 365 days, which we have already seen. Advance for immovable property. If I am selling immovable property, that advance received from a customer does not have a linkage of 365 days. But very importantly, it should end up in selling the property. It cannot be a eyewash. Advance from customer for supply of immovable property, and that this transaction does not happen, then from ab initio it will be considered as a red deposit. Security deposits under the contract. With any security deposit which I have kept for, let us say, getting a tender or whatever, is considered as green deposit. Advance for long-term projects. Let us say I'm constructing a dam for a particular company, or constructing a project, machinery which will take, which is actually a capital goods which I am supplying to the customer, which will take more than 1 year. So there, since it is a capital good, 365 days cutoff is not there. But very interestingly, capital goods from whose point of view? It is not from the company, receiving company's point of view, because from the receiving company, it is actually not a capital good. I am manufacturing capital goods. I am manufacturing stock, capital goods from the other person's point of view. Very interesting that is. So capital goods is what is told. So we have to assume that it is from the point of view of the buyer. Advance for future services towards warranty, maintenance contract as per written agreement or arrangement, as per the normal business terms, or up to 5 years, whichever is lower. Let us say all these motor vehicle companies, if you buy Benz or today any car, they will say that I will give you 3 years warranty. So I will pay the amount in advance. So that up to 5 years, it will not be considered as advance, although it is breaching the 365 days. Advance receivable and allowed by sectorial regulator or with central government and state government directions. Advance for subscription towards publication to be adjusted against receipt of such publications. So all these, let us say some magazine company takes 5 years magazine subscription amount in advance. So that will also not be considered as a red deposit. It will be a green deposit. Chit subscription as per chit fund. Collective investment schemes. More than rupees 25 lakhs in single tranche by startup company as optionally convertible debt. So for startups, there are certain relaxation. This is also one relaxation. Alternative investment funds. Finally, it ends with a statement saying, following to be treated as deposit. Any amount received, whether in installment or otherwise from a person with a promise to give returns in cash or kind on completion of the period specified in the promise or offer or earlier, accounted for in any other manner whatsoever. Now, if let us say jewelry companies are taking money in installments and finally giving them something beyond 1 year, so then this particular thing could be triggered. Any additional contribution over and above the amount under item A above made by a company as part of such promise or offer is also considered to be red there. So very interestingly, these are the 18 green deposits. Relative, we have seen debentures, I have explained, promoters I have seen. Acceptance of deposits before 2014 has to be returned within 3 years. If not, you have to take the permission of the company law tribunal to get a more extension. Now let us see what are the other relaxations to private limited companies. I will not go through everything. I will go only right now. What are the relaxations? With effect from 15 September 2015, directors can give money. We have already seen. Provided, I have put a hash and a X symbol there. Subject to declaration that it is from own funds. The relatives of directors can also give, because initially that was not there. Only with effect from 15 September 2015, relatives of directors also can give in the case of a private limited companies. Again, subject to declaration that it is from their own funds. And in both these cases, they have to subject to declaration that it is from own funds, and it should be disclosed in the financial statements under the notes or in groupings. Not in the groupings, either it should be in the balance sheet or in the notes to financial statement forming part of the financial statement, that this amount is given by directors and the relatives of directors. Unsecured loan received from directors and relatives of directors, the disclosure should be there in the financial statement as notes and also in the board report about money received from directors by relatives. Also, we have already seen members up to 100% of paid up capital and free reserves. But for this, there should be a DPT3 filing, which we will see a bit later on. So this is all about the green deposits. So now I will go to the blue deposits, and that gets me to the end of the chapter of deposits. So what are blue deposits? Deposits collected as such. So let us be very clear. What are this? These green deposits are exempted deposits. And if it goes beyond this for whatever reason, if it is doesn't fit in this particular thing, it will be deemed to be deposits. Then, or it could be deposits collected as such. So for deposits and deemed to be deposits, you have to comply with these norms. If you don't comply with these norms, then it becomes a what should I say? A banned deposit. A banned deposits leading to that up to 2 crores penalty and 7 years imprisonment. So deposits from members comply with section 73 subsection 2, and from publics it is comply with section 76. So from members, you will have to take it from members by issuing a circular by any company. For non-members, only from public. When non-members means public, by issue of circular which is in the form of advertisement, and it can be taken only by eligible public companies, subject to passing a resolution in the general meeting. For both the things, if you are taking money from the members, from the shareholders, there should be a ordinary resolution passed in the general meeting. Acceptance of deposits from members or shareholders. It is very keenly. These are all the conditions which has to be complied with. Even in the case of a private limited company, when you are taking it from the members, section 73 subsection 2, read with the deposits, acceptance of deposit rules 2014. Ceiling is in the case of a public limited company up to 35% of the net worth. In the case of a private limited company, up to 100% of the net worth. And we already saw this. For private limited company, maximum limit is not applicable if and only if subject to no default in filing annual return and financial statements. In the case of startup company approved by DPIIT for the first 10 years. In fact, last week this provision came. That is why George was talking about don't read the books, read the e-books. I mean, if you want to practice in Companies Act, don't read books. Don't read the books, because the books which you have, I mean, I have got a lot of books behind me, as you see, all these books would become stale every week. You know, that's why whoever said that books are depreciated at 40% is wrong. Books are not now fixed assets or property, plant and equipment. Books are like newspapers now. Every day you'll have to change your book. So therefore, instead of changing the book, read the e-book. That's the best way to practice company law. So 10 years as per notification dated 7th of September 2000. So 7th September is last Monday. So this is the latest thing which has come out. Other than above, if and if all conditions below are fulfilled, in other private limited companies, up to 100% net worth you can take, complying with the following conditions. But more than 100% of your net worth also if you can take, provided you are not an associate or subsidiary of another company. Your BFB divided by paid up share capital should be less than 2 or less than 50 crores total borrowings, whichever is less. No default in repayment of borrowings while accepting the deposits. What are the action points? File return of deposits in DPT3 with ROC every year before 30th June. There should be an application form for deposits which should be submitted by the intending depositor. As I told you, depositor should, at the behest of the depositor, you should collect it. That means you can give a standard application form, but he has to fill it and sign it and give. Unlike in the case of a loan, the company will give an application to the bank for taking the loan. So that is how the difference is. Declaration by the depositor that money deposited is not borrowed by him from any other person. Passing of resolution in the general meeting. Apart from the above 4, following additional 5 points has to be done other than private limited companies. What are they? Shall issue circular to all its members. May publish above circular in the newspaper. Shall deliver to the ROC a copy of the circular 30 days before its issue. And auditor's certificate regarding no default in deposit repayment. And deposit taken should be kept in a separate bank account before 30th April, 20% of the deposit amount maturing in the following year. So these are the conditions to be complied with if you are taking it from the members. As far as taking the money from the public, I will not go very much into the details of this, because I think the focus is on the private limited companies, and section 76, it does not apply to private limited companies. All that I can tell is only eligible public companies. We have already discussed that net worth of more than 100 crores or turnover of more than 500 crores plus a special resolution. From members, they can take 10% of the net worth. Any other depositor, that means other than members, they can take another 25%. So for government companies, they can take 35%. They have to comply with the whole lot of conditions, including credit rating, filing of DPT3, application forms, and things like that. So which I will not get into the details. There are other conditions which everybody has to comply with. The validity of the circular, which is not applicable to private limited companies, is only 6 months. Cannot accept deposits repayable on demand or on receiving notice within 6 months or beyond 36 months. Maximum interest they have specified as their RBI rate. Additional conditions, if deposits are secured, they have told. Then there are other rules which has to be complied with. I will now stop by talking about this very important form, because chartered accountants are required to give a DPT3 certificate. Form number DPT3 is a form which has to be filed by every company which has collected either a green deposit or a blue deposit, being deposit or deemed deposit, or a red deposit. Any money which you have collected, which is in any nature, which is not being in the form of share capital. Let me tell you what not being in the form of share capital. Even a company, if it has taken a bank loan, which is actually a green zone, green channel, for that also form DPT3 has to be filed. That is why I said, along with AOC 4, MGT 7, every company every year has to file DPT3 unless the company's balance sheet has got only share capital. If it has got only share capital, then there is no need. Or only creditors. Creditors are also not covered. Advance from customer, just as we saw all the green deposits or the deposits are deemed deposits, they have to file a DPT3. They had to file a one-time form before 31st March 2019, which I'm not talking about because the time is over. Return of deposit. It could be only one DPT3, but they have got 4 radio signals, boxes there, which you will have to tick and then proceed further. It could be either a return of deposit, if you have collected deposits, or it could be particulars of transactions by a company not considered as deposits under Rule 21C, which we saw the 18 points. Only that if you have to tick that particular third point and proceed further. Or if you have both the blue deposit and the green deposit, then you have to tick the 4th point. So either it could be a blue deposit or a green deposit. It could also be a red deposit where you have not complied. That also needs to be called as return of deposit without complying with the requirement. And an auditor has to sign this particular statement only under item number 2 and item number 4. If the company is filing only green deposit, it has got only green deposits. Mostly in private limited companies, we have only green deposits. If it is only exempted deposits, then the CA certificate need not be filed. If it is any other things, because the CA has to certify that all the conditions have been complied with. So only if it is type 2 and type 4, he has to certify. And for this certificate, points to be kept in mind is there is no prescribed format. Audited figures are not mandatory because this has to be filed within 30th June before the audit is completed. And in our office, we have the one thing that only after the audit is completed, we'll come to know particularly that it is a proper amount, because we don't know whether it is more than 1 year advance or things like that only after the audit. So we are not filing anyone until we finalize the balance sheet, or at least on that particular figure. Amount outstanding in DPT3 shall include both principal and interest. Loan received from director during his tenure but later resigned as a director, what we just mentioned. Amount outstanding will still be considered as exempt deposit. DPT3 not as STP return. It is processed by the officials of MCA before approval. So therefore, when you file DPT3, it takes a lot of time for it to be approved. The banning of unregulated deposits, I don't have the time. I will not get into the details of that because I've already completed 1.5 hours of my talk devoted towards this subject. But I can just tell you, money received, if deposit rules chapter 5 is applicable to companies, similar thing is already there under this particular Act of Prohibition of Unregulated Deposit Acts, Scheme Ordinance 2019, which is there even in the case of a partnership firm and in the case of a proprietorship concern. It could either be a regulated deposit or an unregulated deposit. Regulated deposit means under the Companies Act, it is already regulated. For companies, it will not be applicable. Unregulated deposit means it could be a deposit or not a deposit. So there also they have given certain green channel. That means for any genuine business need, advance from customers, loan from relatives is all considered to be, they have defined what the relatives are, not from any cousin is not a relative like that. So we have to take care of that. And deposits by way of business. By way of business, if I'm collecting deposits, unless I am registered as an NBFC, I cannot do that. That is banned. Otherwise, it looks like it is not banned. So I would like to stop at that before I go into the related party transactions. Dunga Chinji, floor is open for questions.
Yes, sir. We will take the questions and then we'll go for a 2 to 3 minute break and then we'll resume.
Sure, please.
Yeah, I'll just take the control of the screen. Give me a minute.
So which means, shall I? Okay.
Yeah, you can stop sharing so that I will be able to.
I think somebody stopped sharing anyway.
No, I think it automatically took over the moment I asked for the rights.
Artificial intelligence.
Okay, we'll start with the question which we left. You said you would like to take it in the end.
Sure.
What is the responsibility of the auditor on advances not passed through the company current account and books and cross the period of 1 year?
Advances not passed through the company current account. I mean, it need not be passed through the current account or SB account is not the question. The question is in the books of the company, whether it is shown reflected as advance from customers. And if that advance from customer is more than 1 year, let me tell you a very interesting situation. If that advance has been given by another company, and I wanted to bring a different angle to it. If that advance has been given by, I'm a company, and let us say X company limited has given me an advance, which is there for more than 1 year, I still can take it as an exempt deposit because, as I told you, under rule 7 or so, any money taken from another company is always considered to be exempt, even if it is received as advance from advance for supplies. So very interesting that is. So advance received from a company as a customer more than 1 year is also considered to be a green deposit. But answering Avinash's question, I would say you will have to look into the books of accounts. If it is not from a company, it will be considered as a red deposit. So either you have to supply the goods or return the money and ask him to give a fresh advance. That's the only answer I can say. Otherwise, as an auditor, you will have to inform the non-compliance in the CARO report. Yes, sir.
How will an advance from customer outstanding over 365 days, but in line with the nature of business? Example, LMW, textile machinery.
Yeah. So as I already told you, if you are supplying a capital good, this is a capital item for the customer. Although the rule says supply of capital goods, it cannot be. I am not supplying. LMW is not supplying capital goods. It is supplying inventory, finished goods. But from the receiver's perspective, it is capital goods. That perspective has not been told in Rule 21C. So I can take the liberty of presuming that it is to be capital goods from the point of view of the customer, at least from somebody's point of view. So therefore, this will still be considered as a green deposit. Exempted deposit. So green deposit is not told in the Companies Act. It is my terminology for which I have patented. So please take it that way.
Okay. In fact, one of the queries have mentioned the green deposits.
Yeah.
Companies offer monthly schemes to its customers going up to 11 months to buy goods. Say a customer pays 3 installments and then forgets to pay the rest. Will such amount be considered as a deposit once it crosses 365 days?
Yes. The moment it crosses 365 days, it will definitely be considered as a red deposit. So please go in search of that particular customer and refund it, or you take it as a remission of a liability and take it as income and pay the GST and income tax and say that remission of a liability.
In fact, the next question was that
interesting, very, very interesting. Any turnover, any money received and for which the goods are supplied and taken as a turnover is not a deposit. Like any money received and advance from customer pending only is taken. So amount which is converted as a turnover is not a deposit. So convert it into a turnover. That's the point I'm saying.
The continuing question is, what if the companies cannot trace such customers because of change in address, phone number to refund such amount? What is the way forward? I think you said you have to take it as turnover and close it.
Or you can consider that customer as Dungarchand and Acharya.
Okay.
I remember giving such money, right, to that company.
No, but a person like Aman K. George.
I know. Answering on a serious note, I think it can also tend towards being contributed to IEPF. When like in the case of today, shares collected, dividends not given. If you are not able to identify the customer, the dividends has to be transferred to IEPF. And not only the dividends, in 7 years, if such a continuous dividends are being transferred to the IEPF, even the shares itself has to be transferred in the name of IEPF. So that is an interesting thing. So similarly for CSR, I'm sure Chinnsamy Ganesan, did he speak about CSR? Once the notification comes, the CSR amount unspent will also have to be transferred to the government funds once that scheme under section 135 subsection 7 gets notified. Yes.
Now, I was just telling that the money transfer to Gururaj and DCJ and auditors like John K. George may not be comfortable. They'll start probing whatever he
He's not there, no? So before
he's there, that's why
he's there. Oh my goodness.
Okay, in case ADT1 is not filed within 15 days, what is the consequence?
Sir, ADT1 is 30 days. So if you are not filed in 15 days, in the next 15 days you file, because the 30 days time is there. But if you have filed it in 30 days, I'm sorry, I think just check up that particular. The point is, if you have not filed it, you can file it with an additional filing fee and take it. But the serious implication could be when you have not filed the ADT3, because if you don't file the ADT3, the next auditor cannot file the ADT1. So that is a point which one has to.
Sir, I think the question is on ADT1, not ADT3. ADT1. If question number 5, Shantakumar has asked ADT1, I'm just interrupting.
Yeah.
ADT1 is 15 days, right?
No. So okay, 15 days or 30 days, that's okay. The point I'm saying is, the point I'm saying is, if you don't file the ADT1, let me say ADT1 is 15 days. Yes, I think the answer is, the question is right. ADT1 is 15. If you don't file it in 15 days, you can file it with a belated return later on. But the serious thing is ADT3, if you don't file, the other person, the next auditor, will not be able to file the ADT1. That's the point I was trying. Yeah, ADT1 is in 15 days, ADT3 is 30 days. Okay. Have been the other way around, is I always keep telling. Because if you don't file your ADT3 in 30 days, the next auditor will not be able to file his ADT1 in that until that period, and that's the point I was trying. Yeah.
If the contract for procuring materials or availing services from MSME itself provides for payment after 45 days, whether it is still required that the purchaser will have to make the payment within 45 days?
Sir, MSMED Act is very clear. It says even if the contract provides otherwise, 45 days is the cutoff. It says the payment to the MSE vendor, MSE, micro and small, although the act is micro, small and medium is not protected under this act. Only medium is protected for some other purposes, but for 45 days payment, only micro and small. Even in our audit report, even in our notes to accounts, even in our balance sheet, we are talking, not in audit report, even the balance sheet for companies and in the notes, we are supposed to give micro and small enterprises. They have been defined as suppliers under the Companies Act. Supplier means micro and small enterprises only. So if it is not paid within the agreed period or 45 days, then you are required to pay him interest, even if the contract states otherwise. Even if the contract says 80 days I have to pay, or if I pay up to 80 days, no interest paid, then also the act overrides the contract.
If the interest is not, I think it answers, but still I will, for the sake of clarity, I will ask, if the interest is not demanded by MSME for delayed payment, whether is it obligatory for the purchaser to pay the interest?
The answer is an emphatic yes. An emphatic yes, because the act, what is happening is the supplier is such a small person that he is actually intimidated by the vendor. Therefore, this supplier is protected with the act, by the act, should I say, by the act. So much so, tomorrow, let me tell you very interestingly, if this vendor is not able to get his money from the supplier, he need not go to the court law to get his money from the vendor, from the buyer. He can go to a cell called the micro and small MSME Facilitation Center. There is something called the MSME Facilitation Center who will lodge the case on behalf of the MSME without collecting any money on record, and they will file it. They'll file the case and fight the case against this particular company. If you see any cases against the company, it will be, let us say, large company limited versus MSME facilitation. So that is how the case will be in all MSME cases. So that is because of this intimidation threat of the small guy. So much so, sometimes it happens that the small guy, in his eagerness to get the order, he will actually give an undertaking saying that I am not an MSME, please give me the order. for me 45 days nahi to sahi, at least 90 days you will give me the money, and I don't want to call myself as an MSME. Utna nahi hota hai.
Has the criteria
In that context, that undertaking becomes the basis. I mean, I can't help it.
okay.
Yeah, that is why I was telling, if this comes it on record to say that the moment I press, today this large vendors are not taking the, not giving the orders the moment you are saying you are an MSME. That is the sad part.
In fact, as you rightly said, few vendors make it, I mean, few companies make it clear that if you are not an MSME, we'll give you order or we'll have a dealing with you. Next is by Bhuneshwari. Has the criteria for MSME regarding investment changed from purchase cost of machinery to income tax WDV?
Yes, it is.
Is the MSME provisions applicable to LLPs? I think we lost.
Sir, it is applicable. Very interesting. Kya Dungarchanji, you have lost me.
Yeah, can you repeat it? Can you repeat your answer?
Yes, the answer is it applies to everybody, including an individual buyer, or very interestingly, MSME supplier and an MSME company. An MSME company also needs to pay to the MSME vendor within the 45 days period or agreed period, whichever is earlier.
Okay. Deposits clause 5 is advance received.
But only thing is the form MSME 1 has to be filed only by a company. MSME 1 has to be filed only by a company.
Okay. Next is deposits clause 5 is advance received by a real estate company for purchase of land pending for more than 365 days at deemed deposit.
I think this question was posed before you saw my full presentation. Correct. Where I very clearly for immovable property, it can be considered as a green deposit.
Next is, dear sir, whether the interest on delayed payments has to be paid between two MSME, that is both the buyer and seller are registered.
Without knowing this question, I have already answered it. Yes, it has to be paid.
Next is up to 100% of net worth. So in the case the net worth erodes, should the deposit also be repaid to match the net worth? I don't know. The answer looks like when you collected it, you can go up to 100%. Subsequently, if it falls below, maybe you'll have to blame your fate. I don't think like in the case of a director, at the time of taking, if he's a director, it is sufficient. Similarly, at the time of taking, I will go up to the net worth of my last audited balance sheet. So subsequent, if it falls, maybe, I mean, I feel that I can argue this case also. There is no straightforward answer for this. I can argue this to say, subsequently, if it has fallen, I think it is not in my control. Next is the question by a regional council member, C. Revati Raghunathan. If a company is in CIRP and is going into liquidation and has accepted deposits and defaulted on the same, then will section 76 apply? How will action be taken on the promoters? The answer is yes. I think they have not given a relaxation for CIRP cases. So if they have defaulted on the same, then also it applies unless there is something in the IBC which gives the company a protection. Next is, sir, I have come across cases where promoters have given unsecured loan to the company, but he had actually borrowed from elsewhere and lent it to company. What is my duty as auditor? Sir, your duty as an auditor is to ensure that this is a ready deposit. Point is, if he has given an undertaking, if he has given an undertaking, you don't make a roving inquiry further. You go with the undertaking. If he has given a wrong undertaking, I would not say, as an auditor, my job is to do a policing job. I will go with the undertaking. But if he has not given an undertaking, then then I know that it is borrowed. Then I have to qualify it. But if he has given an undertaking, although he has borrowed, then that undertaking is wrong and the auditor is protected. Next is securities application money. From when 60 days has to be calculated? From the date of receipt of money or from the date of closure of the offer? Sir, it is from the date of receipt of money, and there you have given 15 days time thereafter. From the date of receipt of money, another 15 days window is given. From that day, within that day, you have to refund. So that is how I think 75 days is good enough. Next, sir, whether deposit received by a private limited company from director or relative and loan taken from bank to be disclosed in DPT3 relatives?
The answer is yes. All green deposits have to be shown in DPT3, but to that extent, if that is the only deposit or only green deposits you have, CA certificate is not required.
Question: B private limited company can pay the purchase consideration over next 3 to 4 years. Whether such transactions for an extended credit period can be constituted as deemed deposit. Could you please explain reporting requirements in the books of A private limited and B private limited?
Sir, B private limited can pay the purchase consideration over next 3 to 4 years. That means in the case of B, it is shown as creditor. It is shown as creditor. So as I already told you, creditor is never considered to be, because it is not supply of money. I mean, I have received goods for which I have to give money. So therefore, from B limited point of view, it is not a deviation. And from A limited, it is books as debtors. So therefore, there is no problem. But under A's books, under A book private limited, where it is a debtor, he has to show it as a non-current asset, because he is very clear that it is not going to be received as current in the next 12 months. If that is an arrangement, otherwise there is no arrangement, means it becomes a current asset.
A private limited company supplied goods to B private limited amounting to say INR 200 lakhs, within brackets no RPT. Considering the long-term relationship, A private limited had agreed based on an agreement.
So no, as I again told you, this is not a subject matter of deposits at all. Because deposit means accepting money. In this case, there is no acceptance of money. There is only acceptance of goods for which money is payable.
Next is, if advance is received by subsidiary being foreign subsidiary and exceeded 365 days, which is shown in the CFS, will it be treated as deposits?
I will only say if any amount received from a foreign entity or a foreign body, as long as it complies with the FEMA, it is considered to be green deposit. So advance received from a foreign subsidiary complies with FEMA requirement. Therefore, it can be put under item number 2 and it will be considered as a green deposit.
Non-interest bearing amount and held in trust seems to give an escape route. Is it correct?
Correct.
Next is under Rule 21C, point number 6. Any other company includes LLP?
No. Any other LLP is a body corporate, but not a company registered under the Companies Act. So company has been defined as company registered under the Companies Act. LLP is a body corporate. So under that heading, LLP will not come.
A real estate private limited company which has collected advance from customers for purchase of land and development in 2012 has few customers which are to be refunded now on account of not being able to get those lands and few times to be registered.
Sir, this will be considered as a violation ab initio. See, what has happened is then everybody will start taking it in the name of advance for immovable property, and then they will say that immovable property nahi mila, wapas le lo. So therefore, understand the spirit. Not possible. I cannot have advance from land unless I have land with me. If you say that tomorrow I'm going to buy a land, today you give me advance, that is not acceptable.
Sir, amount received from customers as advance against purchase of flat by developers doesn't come under the definition of deposits. What is the time allowed for the amount to be kept by the company if the customer does not buy the flat?
Now, as I already told you, this is already answered. Immovable property ke liye, as long as it is given and squared up, there is no problem. So this is an immovable property in that sense.
And a few questions are repeated because the delegates do not know each other's questions actually.
Sure. In that we can skip.
Yeah. How deposit held in trust is to be disclosed in annual financial statement?
I mean, there is no specific disclosure on that. You can just call it as deposit receipt, but the auditor has to ensure that a proper documentation is there to put it under that particular heading.
Is DPT3 to be filed by a company even if there is no deposit?
As I told you, there could be any amount received which could be either blue or green or red. Then you will have to file the DPT3. If nothing is there, as I told you, if your share capital is there, sundry creditors is there, then there is no need. But if you have a bank loan or you have actually taken deposits, I mean, if you have actually taken deposit, you know that you have to file. But if you have a bank loan, advance from customer or any of those 18 exempted list, then you will have to file the DPT3.
please explain.
If that is not there, blue, green, and red, neither of them are there, then there is no need to file a DPT.
And the auditor's certificate are also not required.
Auditor certificate is required only if it is blue deposit. If it is a green deposit, exempted deposits only exempted deposit, then you don't have to file. As I told you, the category for DPT3 can be 4. One-time return, which did not talk. One is a return of deposit. That means I have only deposits and nothing else. Very rare. The third or fourth, it can be. That means I have only exempted deposit, or I have exempted deposit plus deposits. Deposits including dim deposits. So only if it comes under item number 4 or item number 2, the CS certificate is required. If it comes only under item number 3, then CS certificate is not required. Item number 1 is history.
Please explain non-interest bearing amount under green deposit and whether existing deposits can be parked under this.
It should be taken under trust, for which there should be no interest. No comments further on that.
Okay. Are there any overall ceiling on the deposits taken from directors of a private limited company mentioned in serial number 8 under rule 21C?
No ceilings, any amount. See, we should understand one thing, that a person who is a director is fully aware of the company's existence and requirements. So if he gives, he is not a gullible investor. He is a knowledgeable investor. Similarly, any amount given by a company is given by a knowledgeable entity having directors, and therefore the knowledgeable investors need not be protected. So that is the logic behind everything. So that's how we have to understand.
Yeah, we'll take the last one before we break. Directors are borrowing and making a FD with the bank, and the company takes out loan out of such FD of directors. Is this in compliance with the Companies Act or not?
I think, sir, Dungarchan ji, आप ही answer करो इसको, क्या बोलेंगे?
I think substance over form. Simple answer. Substance over
Okay,
form.
I think we will leave it at that. So you can say that, see, the point I'm trying to say always in all situations is, as long as I am able to prove that I have paid out of my net worth and I don't have a net borrowing to pay you, it is okay. So that's the answer. We'll stop at that. I think people will understand that.
Yeah, now the time is 12:28. We'll resume back at 12:32.
Sure. Thank you.
4-minute break where we could.
Sure.
In fact, as per in your parlance, strategic break. Abhishek will start at 12:31 so that we can make the announcements at that point of time. Abhishek, we can go ahead with the announcements.
Yeah, let's do that, Chairman. So, dear members, dear participants, I'll take this opportunity to share a few announcements with you. As you're all aware, we've been organizing many programs and we have some very interesting programs lined up. The next program is tomorrow, 14th of September at 6 p.m. We have a session on it's on auditing and auditing standards, the latest ones. Document. As you're all aware, it's a compulsory meeting to have at least 2 CPA hours from standards on auditing and ethics. So this is a session for 2 hours we have on standards on auditing. CA R. Sundararajan will be the speaker. And 19th of September at 6 p.m. we have a very, very interesting one-of-a-kind meeting. It's a virtual CPE on both the industry perspective, auditing perspective, and management challenges as a CFO's perspective. We have CA R. Lakshmanan, IAS and Executive Director of the Rural Electrification Corporation of India, will be joining us, along with the CFO and Head of Global Services of Messrs. Danfoss India, V.S. Muralidhar. So we have 2 very, very leading luminaries who will be joining us and giving us a very, very interesting perspective. This is scheduled on 19th of September at 6 p.m. On 21st of September at 5 p.m., once again, very, very important session on virtual CP meeting on the income tax exemption for NPOs with a focus on the 12-day renewals and what are the practical aspects in the renewal of your registrations. Many of you may be aware, and if you're not aware, from 1st of October onwards, every single trust across India, whether you've got 12-year registration, 80G registration, 70 years back, or even 7 months back, it does not matter. Everyone has to apply afresh. The 1st October onwards, that new window will open. And by December, you should have got this registration done for it to continue to be valid. So therefore, it's going to be an entirely online process. Gone are the olden days where you go and meet the commissioner and submit the documents. It is going to be done through online portal. So there are new challenges. We have CA Kandasamy M, huge expert when it comes to these matters, and CA Daniel Silvaraj from Madurai, both of whom will be speaking on this session. So this is on 21st of September at 5 p.m. Request everybody to please register and join for these programs. And with this, I think, should we resume, Chairman?
Yes, and the thing is on 23 to 25, we have a GST refresher course also. We'll be announcing the details. Gururaj, you can share your screen and we can take it.
Yeah. Can we start? Dungarchand Ji, I want to ask you a question before I start.
Yes, sir.
Dungarchand Jain and Gururaj Acharya, are they related parties?
No.
Abhishek Ji and Jaman K. George, we are all related parties. Can I prove? You want me to prove? Okay, okay, let me prove. Subsidiary, if there is one company, H company, having S1 company, S1 is a subsidiary of H company, and S2 is also a subsidiary of H company. Are they related? Is H, S1 and S2, are they related? H company is related. S company is related because H and S are holding and subsidiary. H and S2 are holding and subsidiary, again they are related. Between subsidiary 1 and subsidiary 2, are they related? Between subsidiary 1 and subsidiary 2, are they related? If so, what is their relationship? Their relationship is fellow subsidiaries. Fellow subsidiaries. Now, all of us are fellow members of the Institute of Chartered Accountants of India. Okay? So, therefore, we are related.
So, okay, so not as per Companies Act anyway.
I did not ask you as per company. I asked you whether we are related. So, having said that, to setting things in tone, because very important that not only you should smile but you should laugh. When you talk about this, related party transaction is a very serious subject. As I already told at the beginning, I got a message from Pandaraj that he has just now joined. I'm so happy that my guru is listening to my talk today. And he always sends very encouraging words immediately. And those encouraging words are the ones which are acting as a fuel to all of us to perform more and more. So that's the point I wanted to say. And then related party transactions, again, a very serious one. I mean, if you say that it is comparatively deposits is more serious, that is why I took it at the beginning when all of us were fresh. Related parties are important, and definitely it will not be, the penalty is not as much as it is for deposit. Nevertheless, on the chartered accountant who is doing this particular compliance check, it becomes important. So what is the question that is asked in CARO? Whether all transactions with the related parties are two parts. You know, very interestingly, I've tried to dissect this question in an intelligible manner so that we can understand it better. If you read the entire question, somewhere you will get lost. I mean, you will not understand the true spirit of this question. I wish that question was posed like this in the CARO so that each person answers the A and B separately. There are two elements in this. If you read the CARO provision, it looks like one. Point number A, in compliance with, whether all transactions with related parties are in compliance with section 177 and 188 of the Companies Act 2013, where applicable, and whether all the transactions with the related parties are, the details have been disclosed in the financial statements, etc., as required by the applicable accounting standards. So whenever you are talking about section 188, you also have to look into whether AS 18 has been complied with, or IND AS 24, for those of you who are following IND AS 24, has been complied with. So these 2 points have to be noticed. So before I get into the details of section 188, we talked about chapter 5 for deposits, and then I talked about chapter 9 on accounting, chapter 10 Dulkar, chapter 10 on the auditors, chapter 11 is on directors, and thereafter chapter 12 is on meetings of directors and its powers. Now, if you look at this particular chapter, there are about 21 sections. 21 sections, unlike in deposits where we had only 4 sections. But out of this 21 section, I am talking about only one section, which is section 188. But you look at the various sections that are there in this particular chapter, you will find that each one of them is very important. Now, why important? At least 1, 2, 3, 4, and 5. 5 sections out of this chapter, an auditor has to comment in his CARO report. So let me go through all these 21 sections quickly. Section 173 is on board meetings. Section 174 is quorum for board meetings. Section 175 is passing of resolution by circulation by the board. 176 is defects in appointments of directors not to invalidate actions taken. That means the director is wrongfully appointed and people at large do not know that. So there is a principle of estoppel. That means they cannot be stopped from assuming that I have been properly appointed. That is told in 176. 177 is audit committee. When audit committee is required and what is the rules and what is the function of an audit committee is told in 177. In fact, we are supposed to comment of 177 and 188 in the CARO. Then there is a 178 which talks about nomination and remuneration committee and stakeholders relationship committee. In fact, I was the chairman of this particular committee in a board where what is looked into in this particular committee is the fit and proper status of the directors that is coming on board, and what is the remuneration that they have to be paid. So before it goes to the board, this particular committee will go into the details and then the board approves it. And then finally to go with the AGM or the general body meeting. 179 talks about the board powers. What are all the powers that they have? 180 talks about the restriction on the board powers. That means they cannot do. The one is the 179 talks about what all they can do. 180 says up to what they can do. And then 181 talks about company to contribute to bona fide and charitable funds. So what is the limitation? 182 political contributions, what is their role? 183 contribution to National Defense Fund. You know, these are all how much they can do, there are ceilings, etc. 184, I put it in blue for a reason that anything which is put in blue here has a relationship with the related party transaction that I will be talking about. Disclosure of interest by the director. Now, as a director, if there are 12 directors, the company will not know which are all the related parties Section 2 subsection 76 defines what the relatives are, related parties are. So the director only has to tell who his relatives are, which are the entities in which he is interested. So that is a disclosure of interest by the director, told in section 184. Every year on 1st of April, he has to disclose, and whenever there is a change in his interests or whenever a new director is appointed, so this disclosure has to be made. 185 and 186 we have already gone through yesterday. Two important sections: loans to directors, loans and investment by company. If you look at the balance sheet, every item in the balance sheet is controlled by a particular section. If you look at share capital, section 42, section 62, that is issue of share capital. Then if you look at the asset side, any loans given to directors, section 185, or firms in which the directors are interested. If you are making any investments, section 186 controls. If you are taking any money, then the liability side of the balance sheet, it can be section 72, 73 to 76, what we just now saw. Then it could be any other transaction, investment of company to be held in the company name, section 187. So it says that every investment, whatever we are seeing in the balance sheet, it cannot be held in the name of the directors, it should be held in the name of the company only. 188 is related party transactions. So we will be talking about this section in detail. 189 is register of contracts or arrangements in which directors are interested. Although the word transaction is there, related party transaction, transactions, when it goes into the action mode, it is considered as contracts or arrangements. Throughout you will see they have not talked about transactions, register of transactions in which directors are interested. They have used the word contracts or arrangements. I don't know why they have used that particular word, maybe to convey that the transactions could be either a contract or an arrangement. The difference between contract and arrangement is contract is formal, written, whereas an arrangement could be implied without there being a formal written document. So contracts or arrangement, when it is, some of my slides you will see C/A, C/A, that should not be considered a chartered accountant abbreviation. It is actually contracts or arrangements in that sense. So register of contracts or arrangements in which directors are interested. What is this 189 telling? 189 is telling the moment the director discloses his interest under section 184, every time he has to give in MBP1, he has to give his disclosure of interest. And all those interests should be properly captured by the company secretary or the secretarial department in this particular register 189, so that when it is placed before the board, whenever a transaction with that particular entity is happening, the board has to be aware, the audit committee has to be aware that they have to take extra compliance measures. So 190, contract of employment with managing or whole-time director. 191, payment to directors for loss of office, etc. in connection with transfer of undertaking, property or shares. Mostly it says it cannot be given. 192, restriction on non-cash transaction involving directors. If there are any transactions with the directors which are other than in cash, he has not paid cash and he has got some benefit, or vice versa, that has covered in 192. I have marked it in a separate shade because these are the sections 177, 185, 186, 188 and 192. Almost 5 sections out of these 21 sections, we as auditors are supposed to give a comment in the CARO. So we have to see whether all these things have been properly complied with. And contract by one-person company. In the case of a one-person company, where is the question of he having a board meeting? Because he is only one shareholder and one director. So how in the one-person company the transactions with respect to the board meetings has to be conducted is told in 193. 195, 194. Dealing with forward dealings and insider trading has been removed from Companies Act, and anyway because it is covered in the SEBI format, so whatever is covered, they don't want to cover it in too many acts, they have removed it from here and converted it into SEBI anyway. So we have about these many sections which we as auditors under chapter 12 have to be concerned with. A very important chapter, maybe chapter 9 and chapter 10 के बाद, if there is any other chapter which is very important from auditor's perspective, it is chapter 12 and chapter 5. That is why Dungarchandji gave me these 2 chapters to be dealt with. So when I am talking about section 188, I will try to make a comparative analysis with accounting standard 18. So section 188 and accounting standard 18, section 188 of the Companies Act, it gives a specific definition as to what a related party transaction is, who are related parties and what are the transactions. Whereas in Accounting Standard 18, broad principles are given as to who are related parties and what are related party transactions. Because our standards are mostly principle-based standards. They are not rule-based standards like US GAAP. So our standards have given broad principles. When we talk about control, when we talk about significant influence, those are the principles. Sometimes you may have less than 50%, but if you are still controlling them, you become a holding company according to Accounting Standard 18. So that is how we have to see. Objective, section 188 is very objective, AS 18 is subjective. 188 is disclosure in form AOC 2 annexed to board report. And disclosure of related party transactions in the financial statements is not it's told in a few places, but definitely under the director's report, AOC 2 should be an attachment. Whereas Accounting Standard 18 tells us what are all the disclosures in the general purpose financial statements about AS 18. So that is related party disclosure. AS 18 is related party disclosure, whereas section 188 is related party transactions, compliances and disclosure. So as we already see, it is compliances plus disclosure. Compliance can be concurrent. Disclosures will be year-end, whereas in AS 18 it is only disclosure at the year-end. No disclosure required if there is no related party transaction entered into as per section 188. As per Accounting Standard 18, if there are related parties in the nature of control, disclosure is required even if control exists irrespective of whether or not the transactions are there. If there are transactions, definitely you have to give it in AS 18. Even if there are no transactions, you will have to spell out which are all the entities which are controlling you or which you are controlling. So either you are a holding company or a subsidiary company, the list of that names has to be given whether or not the transactions there as per AS 18 and in the AS 24. So I have tried to explain section 188 in one particular presentation, in one particular sheet. Let's understand this. If we understand this, maybe we have understood section 188. Company entering into a contract or arrangement with the related party. That is a question. And we have already seen what is a contract and arrangement. They have not defined related party transactions. The related party transactions are told as contracts or arrangements with related parties. So we have to see who the related parties are. We will see that bit later. And we will see what are those contracts and arrangements also a bit later on. But the difference between a contract is formal and in writing. Arrangement may be informal, may be on account of past practice. What we say, constructive arrangement. We have something called a constructive obligation. Accounting Standard 29 and Accounting Standard 15 talks about obligations, whether it is contractual or constructive. A constructive obligation is an obligation which has to be constructed based on the practice without the documents. If it is a contractual obligation, that means the obligation is visible through the contract, whereas a constructive obligation is an obligation which has to be constructed based on the past practice. So an arrangement can be informal, need not necessarily be in writing. So that is how they have brought these two terms instead of transaction. So does it apply to private limited company? The answer is yes. Both these chapter 5, which we talked about, and chapter 12, which we are talking now, is applicable equally to private limited companies with certain relaxation. So are there any transactions entered with related party? If the answer is yes, the next question you will have to answer is whether it is done in the ordinary course of business and at arm's length. If the answer to that is yes, there is no action required under 188, but disclose in director's report. That's it. Stop. When that is the flow chart, you stop there. But the $1 million question is, how do you say whether it is done in the ordinary course of business and at arm's length? That is the biggest challenge, to say whether a transaction is done in the ordinary course of business and at arm's length. Now, the simple question that I will ask is, the directors, let us say director has a flat which the company wants to use it for its staff, and that particular property is given on rent to the company, or it could be used as a registered office of the company, and the normal rent is being charged. So do I say that it is in the ordinary course of business and at arm's length? Maybe all the flats in that particular area are given at 1 lakh rupees per month rent. And this director has also given it at 1 lakh per month. So it definitely satisfies the arm's length pricing. But do you say that it is in the ordinary course of business? What is ordinary course of business? Is it the one which is there as your main objective? Or can you do all those things that the company has to have a registered office? Company in any case will have to have a guest house for taking care of its guests. So therefore, a company cannot run without a registered office bar a guest house. If that is the answer that is taken, then this particular transaction stops here. So therefore, the $1 million question is whether it is, how do you decide whether it is in the ordinary course of business? It's highly subjective, and whether it is at arm's length is another subjective. So it becomes double subjective on this particular aspect. However, our institute has given the guidance when it talks about CARO, when it talked about CARO, a guidance note on CARO. When we have to answer this question, they have given us certain guidance. How do you say that it is at arm's length? So auditor may test transactions of arm's length basis based on the TP mechanism in use for the purpose of IT Act. Now, all of us are aware of the transfer pricing mechanism or the arm's length calculation, which we do for 92E cases where the transactions are done either with the associated enterprise abroad or with the specified domestic transaction where between the associated enterprises, the transactions are more than 20 crores. Then in that context, I will have to see whether the transactions are done at arm's length price. And there they have given us a guidance that I can use the most appropriate method using any one of the 5+1 methodology of comparable uncontrollable price, the retail price method, the cost plus method, the profit split method, the transaction net margin method. These are the 5 methods. Depending on the situation, I have to select which is the most appropriate one to determine the arm's length price, or any other method if this is not suitable. So I have to take a cue from the transfer pricing study to find out whether it is done at the arm's length. So in this example of this flats, I took the example and said that others are giving in that particular apartments, they are giving normally at 1 lakh per month. So therefore, this director has also given at 1 lakh. Other flats are also being rented at 1 lakh. So I'm using the comparable uncontrollable price method. So if I'm comparing others where I don't have a control, everybody is giving at that particular rent. So therefore, this also comes under the comparable. The other methods I don't have to see because that is the most appropriate method. So similarly, I have to see whether which method is the most appropriate and decide accordingly. Assess whether transaction is in the ordinary course of business is very subjective. The guidance note also says this. Factors mentioned herein below may help in making this assessment. So section standards on auditing 550 dealing with related parties has listed certain examples of transactions which are not or which are outside the entity's normal course of business, which are complex equity transactions such as corporate restructuring or acquisitions. And I am involved in that particular, the director is doing something of that size, or he is being paid a fee on that particular matter, then it is not in the ordinary course of business. Transactions with offshore entities in jurisdictions with weak corporate laws, leasing of premises or rendering of management services by entity to another party if no consideration is exchanged. Now, maybe the director is taking the company's flat and not paying rent. So that is not in the ordinary course of business. Sales or transactions with unusually large discounts or returns. Transactions with circular arrangements. That means sales with a commitment to repurchase. That means we call round robin case. So this is also not in the ordinary course of business. Transactions under contracts whose terms are changed before expiry. So this our guidance note warns us, please take care of that. This is not in the ordinary course. Some more thing it is told, some indicators based on which one may consider the following aspects while performing evaluation of the ordinary course of business are whether transactions covered in the objects in memorandum of association, whether the transaction is usual or unusual, both from the company and its line of business, frequency with which it is done, whether it is done at arm's length price itself could sometimes be considered as, so let us say the director of a company is actually staying in a hotel room, or BPCL director, Bharat Petroleum director, is filling up the petrol from his own company. So he doesn't have to treat it as a related party transaction, because normally he will also fill it at 75 rupees or 80 rupees per liter. So, or a BSNL or a Airtel mobile company having his own mobile for which it is being charged in the normal course. So business purpose of the transaction, whether the transaction is done on similar basis with other third parties, and size and volume of the transaction. If it is very negligible, means it is okay. So for transactions entered into by the company in its ordinary course of business with its related party at arm's length, verify the documentary proof. Check details of persons covered under this clause from MBP 1 and from the register under section 189. So we go back. So if the answer is for this, in the ordinary course of business and at arm's length, no further action required under 188. If not, then I will have to go to see whether it is a related party transaction stipulated. All transactions with the related parties are not stipulated. So they have very clearly stipulated a few transactions. If it is only a stipulated transaction, only then I will see whether I have to go further. So what are the related, who are the related parties and what are all the related party transaction? So let me finish off what are the related party transactions. In section 188, they have specified only 7 headings under which the related party transaction gets covered. Let us see what gets covered and what does not get covered. Now, 188 bracket 1 bracket A, sale or purchase of supply of goods or materials. So I have told it as movables. That means if it is a sale of goods or material, purchase of goods or material, or supply of goods or material. So one is sale. The difference between sale and supply, I will take it as sale means stock in trade, supply means made to order. So maybe something like that. And purchase means purchase of goods or material. So anyway, goods or material in that sense. So they have covered everything. Somebody should not say that it is not good, but material or good, not good. They have tried to cover everything. Basically, it's talking about movables. Next, B covers selling, disposal or buying of property of any kind. So property, like even in our section 56.2.7 defines what is property for the purpose of 56.2.10. Here also it is not defined. So we may import the definition property includes immobile property, and normally we are talking about immobile properties here. Anyway, movable properties are covered in A above. In section, so this could be selling of property, disposing of property, buying of property. If the transaction involves any one of them, it is considered as a contract or arrangement for which you'll have to check further on 188 compliance. So leasing of property of any kind. That means I am renting out the property of the company or taking the other person's property for the company. So both the things are covered. Availing or rendering of services. So it could be availing of services or rendering of services. Now there are very succinct difference as to availing of services means the company is availing the services. Rendering the services means the company is rendering service to the related party. So both the things are covered. So in short, if you see, most of them are talking about the P&L account, either debit or P&L account credit. If you may not come across, unless very, very rare situations, balance sheet items. If they are buying machines, then it could get covered under goods and materials, or if they are selling properties and buying properties, it could be a balance sheet item. But then mostly otherwise it is talking about P&L account items for sure. Availing or rendering of services, appointment of agent for purchase, for sale of material, services or property. Immobile property, if the company is doing a sale of immobile property and the director is acting as an agent and getting an agency commission in between. Appointment to any office or place of profit in the company, subsidiary and associates. So company, subsidiary and associates, CSA that is. Underwriting subscription of securities or derivatives of a company. So these are the only 7 transactions which are considered as related party transactions. So let us for a moment understand what are not related party transactions. Issue of shares. Issue of shares is not a related party transactions covered under section 188. Now one has to look into compliance of that particular chapter. I think chapter 4 deals with that. Section 42, section 72, section 62, so those are the ones which have to be looked. Issue of securities, what are safeguards have to be taken, has to be taken care of. Because they say for the purpose of, let us say the company is holding a share, somebody's share invest under the investment side, and that is being sold to the related party, that could get covered under 188. Whereas the issue of shares of the company is not a subject matter of 188. So that's the point I wanted to say. What else will not get covered? Any loan transaction. What you covered day before yesterday. Chinnsamy Ganesan must have spoken about 185, 186. That is not a subject matter of 188. So, and similarly, remuneration to directors. Remuneration to directors is talked about in the next chapter 13. Chapter 13 deals with 197, 198, deals with remuneration to directors. But any other payment made to a director, not being a remuneration. Let us say a company's director is paid professional consultancy fee, his sitting fee or something like that, not forming part of remuneration under 197, 198, then it will be covered under 190, 188. Similarly, any remuneration paid to a relative of a director, then that would come under F, appointment to any office or place of profit in company, subsidiary company or an associate company. So we will see what an office of place of profit is. Office of place of profit is defined like this: where such office of place of profit is held by a director, if the director holding it receives from company any remuneration by way of salary, fee, commission, perquisite, rent-free accommodation or otherwise, over and above the remuneration to which he is entitled as a director. The remuneration as a director, whole-time director or a managing director is dealt with 197, 198. But anything above than, more than that, what he receives becomes an office of place of profit. Let us say an underwriting commission or a technical fee or a professional fee, it could all get covered here if it is not covered in ABC earlier. Where such office of place of profit is held by any individual other than a director. So director other than a director means a relative of a director, or by any firm, private company or other body corporate, if the individual firm, private company or body corporate holding it receives from company any remuneration, salary, fee, commission, perquisite, rent-free accommodation or otherwise, then it is considered as office of profit for the purpose of our definition. Similarly, what is arm's length price has been defined in 188 as means a transaction between two related parties that is conducted as if they were unrelated, so that there is no conflict of interest. So we go back to say this is the related party transactions. Anything more than this 7 will not be covered under 188. How is it related party transaction covered under AS 18? Para 10.2 says a transfer of resource or obligation between related parties regardless of whether or not a price is charged. Regardless of whether a price is charged is considered as related party transactions. So related party transaction in AS 18 can go beyond these 7 transactions. So even a loan transaction, a share transaction or a salary transaction can be covered under related party transaction for the purpose of AS 18 and Ind AS 24. So let's go back to understand this particular thing. We have now understood what the related party transactions stipulated are. Only 7 numbers. Next, if it is not a transaction told under those 7 headings, no action required under 188. Look into the action required under 185 if it is 185. For issue of shares 4262. For remuneration 197. So you'll have to look at that. I am not, so it doesn't come under today's subject. That's what I am trying to say. But it comes under the auditor's purview. That's a different situation. So related party transaction, if it is stipulated, if it is yes, then I go below. Whether the limit is breached, then for every transaction with that particular related party, they have told, is it within the limit or above the limit? If it is within the limit, then just take a board consent. That is, just take an approval from the board of directors and complete that particular transactions. If that limit is breached, then you will have to go to the, apart from the board consent, you'll also have to take a prior approval from the general body meeting. So let's see what those transactions are. We have seen these related party transactions. We'll see what those limits are. If it goes, again, we are talking about 1, 2, 3, 4, 5, 6, 7. What the same thing what is told earlier, 1, 2, 3, 4, 5, 6, 7, 1, 2, 3, 4, 5, 6. I think one of them is got clubbed there. So sale or purchase of goods or materials of goods, sale, purchase or supply of goods or material. What we'll have to see is, if this limit breaches, then I go to the general body and take a prior approval. If it is within that limit, it is a board approval. So what is the limit? I have to see whether it is 10% of the turnover. If the company's turnover is 100 crores and I am selling something to the related party more than 10 crores, or I'm buying something from the related party more than 10%, or together I am doing 7 crores of purchases and 7 crores of sales, then it crosses more than 10 crores, then I will have to go to the general body meeting and get their approval. Let me be very clear. On 18th November 2019, they made an amendment. What I have struck off there below is, earlier it read like this: 10% of turnover or rupees 100 crores, whichever is lower. Now imagine Reliance Industries turnover. Reliance Industries turnover per day is about, we say per hour is more than 200 crores, or per minute it is more than 20 crores or 2 crores, like that. That is how the numbers are told. For Reliance Industries Limited, if they say 100 crores transaction with a related party, that means so many transactions have to come to the general body meeting for approval. So therefore, to remove that, they have removed that cap of 100 crores. Similarly, all the 100 crores or 50 crores cap, which they have monetarily fixed, they have removed it, because for big entities, that used to be making the numbers more to go to the general body meeting. So to enable ease of doing business, they have just kept the turnover limit, and the ceiling in absolute numbers have been dropped. So I'm not talking about the subsequent ceilings. So selling, disposal or buying of property of any kind, 10% of the net worth. If it is more than 10% of the net worth, because it is related to asset, they have linked it up to the net worth that is there in the liability side. Leasing of the property of any kind, then it is more than 10% of the turnover. That means the rent involved is more than 10% of the turnover. In very rare situations, it can happen. Availing or rendering of services, then it is 10% of the turnover. And then appointment to any office or place of profit in the company, subsidiary company or associate company. If the monthly remuneration is more than 2.5 lakhs, then it has to go to the general body meeting. Underwriting, subscribing of securities or derivatives, if the remuneration involved is more than 1% of the net worth. So that is how the limits are fixed. Turnover and net worth as per audited balance sheet. And they've also told, in the case of a wholly owned subsidiary, ordinary resolution passed by the holding company is sufficient for entering into related party transaction between the wholly owned subsidiary and holding company. Now let us see, if the transaction were to happen between a holding company and an ordinary subsidiary company, not a wholly owned subsidiary company, who has to pass this resolution? Both the companies have to pass this resolution looking into their affairs. Now, that holding company, if it is selling more than 10% of its turnover to the subsidiary company, and the subsidiary company is buying more than 10% of its turnover, whatever purchases happen is more than 10% of its turnover, then the resolution from the AGM with the prior ordinary resolution should be taken both by the holding company and subsidiary company. However, they said, if the holding company has a subsidiary which is wholly owned subsidiary, then the resolution passed by the holding company is sufficient. Because if the holding company approves, subsidiary company may wholly owned subsidiary means this holding company only has to again approve it. So there is no point in that being approved. So therefore, they said this need not be done as long as this company prepares a consolidated financial statement in India. So that is how they have put that particular condition. So this is the limit. So we go back and look into this particular chart. Is the limit breached? If the limit is not breached, a board resolution is sufficient. If the limit is breached, the answer is board consent plus prior ordinary resolution. So that is how you have to look into the entire section 188. What are the other provisions? Elaborate disclosure in notice of board meeting and explanatory statement to general meeting. I will show what those disclosures are. Then elaborate disclosures in the director's report. As we already saw, AOC 2 has to be attached to the director's report. And in that AOC 2, we'll have to say what is done at arm's length and what is done not at arm's length has to be given a disclosure. Then interested directors are member not to vote at the board meeting or the ordinary resolution. However, there are certain exceptions to private limited companies, which we will see. And default Suppose they have not taken a prior confirmation from the board or the prior confirmation from the general body meeting, what happens? The transactions becomes voidable. It doesn't become void, it becomes voidable at the option of the board or at the option of the shareholders, as the case may be. That means they can reject and say, whatever you have taken, you have to give it back. Or they may approve it subsequently through a subsequent ratification. Until then, it will be considered as a non-compliance. Now, very interestingly, we'll have to see one more thing. If the company has an audit committee, then the audit committee of the board to approve all transactions with related parties. Please understand, all transactions with related party is not the same as all related party transactions. Related party transactions are only those 7 transactions which I just now told you. All transactions with related parties means it will go to even remuneration, even it will go to issue of shares. It can go to section 185, 186. So all transactions with the related parties has to be approved by 177 audit committee, irrespective of whether it is in the ordinary course of business or at arm's length, whether the limit is breached or otherwise. So audit committee of the board required for all listed companies and public companies with paid up capital of more. Now, when is the audit committee required? Audit committee is not required for a private limited company. That is a saving grace. Audit committee is required for every listed company, and in the case of every public company whose paid up capital is more than 1 crore, 10 crores, or borrowings or deposits, or both put together is more than 50 crores, or their turnover is more than 100 crores. Then an audit committee is required. Audit committee of the board can give omnibus approval for related party transactions. I mean, I should not use the word related party transactions because my company secretary in the office corrected me to say the word related party transaction means those 7. All transactions with related parties. ACB can give an omnibus approval for all transactions with related parties on an annual basis, as told in Companies Amendment Act 2015. Holding, subsidiary, associate, and fellow subsidiary not to be treated as related party transaction in case of private companies. So that is a respite which is given to private limited companies. So we have seen what arm's length transaction is and what it is not. And now we have to see who are all the related parties. Who are all the related parties in relation to a company? With reference to a company means, you will see that eventually there are 9 types of related parties. If you dissect them, it could be a director or the relative of a director. That means I have put 2 types. Now within relatives, you can have, as I told you, aju baju, aage piche, just upar, just niche, son-in-law and daughter-in-law. So these can all be the relatives. So then in that case, the number of 2, which I have given it on the right side, can be more than 2. Then key managerial personnel. So then the word relative we have already seen. I mean, I think I've already explained aju baju, aage piche, just upar, just niche, and son-in-law and daughter-in-law. So 1 is taken care of. Key managerial personnel or his relative. So he need not be a director, but if he is a CFO or is a company secretary in employment, company secretary is required to be appointed by every company whose paid up capital is more than 10 crores, even in the case of a private limited company. So key managerial personnel or the relative of a key managerial personnel. Who is a key managerial personnel? He can be a CEO, MD, manager. So a CEO not being a director, managing director, of course, he is a director, manager not being a director, company secretary, whole-time director, CFO, such other officer not more than 1 level below the director who is in whole-time employment designated as KMP by the board. I mean, for every board, there could be a 1 level below. Let us say in State Bank of India, we have deputy managing directors. So deputy managing directors, if they are designated as KMP, then they will also become the KMP for this purpose, and their relatives are also becoming related parties. Such other officer as may be prescribed. Key managerial personnel in the case of accounting standards sub 18 is those persons who have the authority and responsibility for planning, directing, and controlling the activity of the reporting enterprise. So key managerial personnel, firm in which the firm means partnership firm in which the director, manager, or his relative is a partner. So we can have 4 types of relationship there. Private company in which a director or manager or his relative is just a member, just a shareholder, or he is a director, becomes a related party. So a company and a private limited company. I am talking of a public company or a private company. And in this, my director in this company is only a shareholder in the another private limited company, or my director is also a director in that particular company, then these two companies will become related parties. For private limited company, a member or director, look at this. In this company, I am a director, and in this private limited company, my wife is a member or my wife is a director. Then these two companies will be treated as a related party. Any transactions between them has to be tested for 188. Public company in which the director or the manager is a director and holds more than 2% of its paid up share capital. Originally it was war, now it has been made into and. That means the possibility of it being called as a related party is that much lesser. So this company is a company, private or public, and in this another public limited company, my director is also a director and he holds more than, and he is a shareholder holding more than 2% shares in this particular company. Then these two companies are said to be related parties. Any body corporate whose board of directors or managing director or manager is accustomed to act in accordance with the advice, direction or instructions of the director or manager, not applicable to directions or instructions given in professional capacity. Any person on whose advice, directions or instruction a director or manager is accustomed to act. See, sometimes what happens, the director or the promoter is outside. He doesn't want to be in the forefront. He has made his driver and his wife as directors. I mean, I'm just putting it very casually. Some companies, do happen like that. But these are actually controlling those directors. Then in that context, the person who is controlling the directors or the board or the manager or in whose advice this board is working, that also becomes, this person will also be considered as a related party. Holding, subsidiary company, associate company, fellow subsidiary, investing company and venture company. I told you what is an investing company. Company which is holding shares of the associate companies is an investing company or venture company. They have given two names for them. Either they will be investing company or venture company, as told in the Companies Amendment Act 2017. Subsidiary company means where I'm controlling more than 50% of their total equity shares. That's what I want. I mean, total voting power. Total voting power. Earlier it was talked about total share capital. Then we used to take even the preference share capital. Now we don't have to take the preference share capital. Total voting power means only equity share capital, as told in Accounting Standard 18. Such other person as may be prescribed. So the ninth relationship as told in 188 is such other person as may be prescribed. Director, I mean, for the moment the rules have prescribed director other than independent director, KMP of holding company or his relative is one more type of person as given under the rule, that is rule 1.3 of the company's rules, that is. So we have about 9 types of relationship as told in 188, which can actually go up to 31 types, 31 as I put it on the right side. So related party for the purpose of Accounting Standard 18 is, as per para 10.1 to Accounting Standard 18, parties are considered to be related if at any time during the reporting period, one party has the ability to control the other party or exercise significant influence over the other party in making financial and or operating decisions. So this is why I said this is very qualitative, and whereas related party for Companies Act is very objective. So we have more or less completed 188 in understanding. Let me represent this because we have understood all the components there. Company entering into contract or arrangement, contract being formal and written, arrangement being informal or oral or based on past practices with the related party. Who the related parties are, we have seen those 9 related parties. All companies, including private limited companies, this applies. Whether it is in the ordinary course of business and at arm's length. If the answer is yes, then no action required. If the answer is no, related party transaction, whether they are related party transactions stipulated, those 7 numbers. If the answer is not those 7 numbers, no action required under 188, but to test under the respective other sections. If there are not, if there are, yes, it is a related party, those 7 transactions, then I have to see whether the limits of the 10% limit of turnover or net worth or 2.5 lakhs in the case of Office of Profit have been breached. If it is not breached, I will go to the board. If it is breached, then I will go to the AGM or a general body meeting where I will take a prior consent. Then there are disclosures and other compliances. In any case, all transactions with related parties have to go through the audit committee if it is there. So we have seen all of this. Yes. So let me now talk about ban on voting by the interested or related parties. Now, there are board meeting or general body meeting in a private company. In the board meeting, the directors, the interested directors can participate in the board meeting after disclosure of interest. So that is a relaxation which is given. If it is a public company, an interested director, initially it is told that a related party should not participate. Then they came out with the context saying related parties means all directors are related parties in that sense for that particular company. Then they said, on a clarification given on 17 July 2014, they said no related member of a company shall vote on ordinary resolution to approve related party transaction. Means related party refers only to the related parties in the context of related party transaction for which ordinary resolution is passed. So that is how to say that concerned director has to absent himself. Only the disinterested director should participate in the board meeting. Similarly, when it comes to the general meeting, in the case of a private limited company, the interested director or the related party can vote in the ordinary resolution, whereas in the public limited company, he cannot vote in the ordinary resolution. Exception told, if 90% or more members in numbers are relatives of the promoters or are related parties, then they can still continue. Because if 90% are only 10% need not, only if there are 10% in numbers, then even the 90% can participate is what is told there. So related party transactions not applicable to transaction arising out of compromises, arrangements and amalgamations. Existing related party transactions, which was there before 2013 Act came, will not require fresh approval under 188 till expiry of original term. So there is no, it is grandfathered. In short, it is grandfathered. There are certain disclosures which are told in the board meetings and also some explanatory notice which has to be given in the general meeting notice. So other provisions regarding related party transactions are every director to disclose his interest in any other company firm. I already told you 184 tells me that every director in the first board meeting of the year he participates. First board meeting in which he participates and first board meeting of every financial year, he has to disclose his interest by giving a form MBP1 to the board, to the company, and whether or not this has to be given, whether or not any transaction with such entity is done. He cannot say that if it is done, I will give. No. Who are all my relatives? Who are all my transactions? Who are all my related parties? Those 9 related parties, I will have to give it to the company in MBP1 every year. And section 167 says, if there are any transactions which contravenes 184, which we talked about giving MBP4, then he contravenes 184 relating to entering into contracts or arrangement in which he is interested, he shall vacate the office of the director. So that is the seriousness with which it happens. And what happens if there is a breach? We have already discussed this. If not ratified by the board of directors or shareholders meeting within 3 months, such contracts or arrangements shall be voidable at the option of the board or, as the case may be, of the shareholders. Further, directors to indemnify company against any loss incurred by it in the contract arrangement is with his related party or was authorized by him. Without prejudice to the above, company may proceed against director or other employee entering into related party transactions, contracts or arrangements in contravention of 188 for recovery of any loss sustained by it as a result of such contracts or arrangement. The penal consequences are listed company 25,000 to 5 lakh rupees penalty and imprisonment of officer in default and the directors in charge up to 1 year. And in the case of other companies, 25,000 to 5 lakhs. So what are those disclosures which are required in the board report? Related party transactions to be disclosed in board report with justification in AOC 2. AOC 2 will be contracts or arrangements or transactions not at arm's length and details of material contracts or transaction at arm's length basis. Now we have to see what are all the done at not at arm's length. I have to give name of the related party and nature of relationship, nature of contracts or transactions, duration of contracts, salient justification for entering into a contract arrangement or transaction not at arm's length. I'll have to justify dates or approval by the board, amounts paid as advance if any, date on which the special resolution, sorry, it's not special resolution, ordinary resolution, date on which the ordinary resolution is to be passed. And on the other side, I have details of material contracts or arrangements on transactions at which on arm's length basis, because this has not gone to the general body meeting. Because it is done at arm's length basis, it is not even gone to the board. But still I have to disclose name of the related party, nature of the contracts or transactions, durations of the contract, salient features, date of approval by the board, if it is approved by the board, if any. That is why, because I said if it is at arm's length, it need not go to the board. Amount paid as advance, if any. So they said material contracts or arrangements. So what is meant by material? Materiality has not been defined in Companies Act, but SEBI has told that if any aggregate transactions in financial statement is more than 10% of the annual consolidated turnover, it has to be taken into account. Otherwise, very interestingly, I thought I will just give this as a take-home point. The definition of materiality in Ind AS has got amended 2 months ago on 24th of July 2020, where it said, if you see the earlier definition, existing definition, and the new definition, the underlined portion is new, and what is given in blue, I mean the yellow shaded blue portion is actually the one which is making a major difference. And information is considered material if omitting it was always there, misstating it was always there, or obscuring it. You have given it in such a manner that it is actually maybe camouflaged amongst so many other information. The most vital information you have cooched in between when you have given a lot of other informations. It should have been given, the prominence with which it should have been given has not been given. Even then it will be considered as material. It could reasonably be expected to influence the decision that the primary user of general purpose financial statements. So he has told that earlier it said influence the economic decisions. Now he says reasonably be expected to. I mean, not in all the cases, but reasonably expected to. And then he says that the primary users of general purpose financial statement. I mean, I am not concerned with others. It is only those users of financial statement. They have told in this particular Ind AS 1 who the primary users of financial statements could be, make on the basis of those financial statements. So even obscuring could also be covered under materiality. I just thought I will bring it, because of which 11 standards, I mean, on 24th of July, 11 Ind ASs have been amended, out of which 4 standards are amended only because of the definition in the change in the word materiality. So how do I report in CARO? If auditor comes across any non-compliances or differences in opinion, then it should be reported in the following format, is what is given in a guidance note: nature of related party transactions and underlying transactions, amount involved, and remarks. So that is what is the details of non-compliance has to be reported. Now, one point on the related party transaction, having understood all this, is sometimes if the transactions with the related party transactions are huge, then that could also be a key audit matter under SA 701 for the purpose of reporting. One of such a reporting which had happened in a Bangalore-based company is related party transactions. The gross revenue of the company is mainly from related party. And I mean, SA 701 is today applicable only for listed entities and for all those entities which voluntarily wants to, all those auditors who want to give out this particular information about non-listed entities also are free to give. For in the case of a listed entity, it shall be given. So the gross revenue of the company is mainly from the related party. Determination of arm's length transaction is dependent on various business decisions and judgments made by the management. And how did the auditor satisfy himself to say that it was done at all the compliances have been taken care of is the auditor's compliance. And I thought that related party transactions with respect to income tax is we'll have to report whether 40A to be parties, what are all the transactions, and that has to be reported in the tax audit report also. And if there are any international transactions or specified domestic transactions of more than 20 crores, that also needs to be kept in mind. So with this, I come to the end of my presentation. I thought I will talk about one important aspect. Already 1:30. Can I just take 2 more minutes? I have 2 more slides because that is the punching slide at the end.
Please do so.
I wanted to talk about auditor's role. We have understood, but we chartered accountants are the best fit for doing the company law practice. Why are we the best fit to do the company law practice? Because we can have I mean, if you see the books behind me, I mean, I will have Income Tax Act, I will have the accounting standards, I will have the Companies Act, I will have also the GST. So I can give a total solution. If a particular person goes only to a company secretary, not to belittle them, but all that I can tell you is he will have only Companies Act. So he will look from the compliances only from the Companies Act. Let us say loans to directors. Loans to directors 185. He will say, okay, no problem. In the case of a particular situation, you can give a loan to a director by doing a particular compliance. But then under income tax, it could breach section 2 subsection 22 clause E, deemed dividends. It will be considered as a deemed dividend. So one has to look from that angle, which only a chartered accountant is capable of talking about that with equal force. So like that, I was just given here. Apart from exclusive domain area like audit and certification, he is an all-rounder who can have a holistic approach when it comes to allotment of shares. Of course, we have to look into 61, 62, 42 of the Companies Act. In Income Tax Act, I have to see whether the allotment is happening at a premium far in excess of its fair market value, in which case I have to be worried about 5627B. Or from the recipient's point of view, whether he is paying a consideration lower than and getting more than the fair market value. If so, he will be taxed under income from other sources under section 56(2)(10). If there are any transfer of shares between the entities, while 56 talks about how the transfer has to be recorded in the books of the company, I will have to look into the Income Tax Act from section 45, whether there are any capital gains. 50CA, which is the equivalent of section 50C, to say what is the fair market value of that particular transfer. If that comes in, then I will have to take the deemed fair market value as a sale consideration in the case of closely held companies. 56(2)(10) and 79. 56(2)(10), the person receiving it, if he's receiving shares by paying less than the inadequate, if he's paying inadequate consideration, he will be taxed 56(2)(10). Section 79 means whenever there are transfer of shares, the company has to look into whether there is a change in the shareholding pattern, so much so that 51% shareholders who were there at the time of incurring the loss, and in this year when you are actually claiming the loss, if more than 51% shares have got transferred, that loss will have to be surrendered. You cannot carry it forward in future. So that's 79 angle. So loans to directors 222E, related party transactions 40A2B, CSR 135 Companies Act. With respect to Income Tax Act, I will have to look into whether it is allowed for, it will be allowed under 80G, although 37 says it is not allowed. Under 35A also it will be allowed. Conversion of a company from LLP to company, section 366 compliance, whereas Income Tax Act may, section 47 subsection 13 may say it is not considered as transfer, but 56(2)(10) there is no respite. Well, that's a danger there. That's why I've given it in red. Similarly, the reconversion from company to LLP, buyback of shares, mergers and acquisitions, winding up. All these will have a bearing on the Income Tax Act, which has to be seen. And I close by saying tips for company law practice. If at all you're doing a company law practice, update regularly. I hope George is there listening what he said. I've already written there. Require greater reading or training to self and entire office. It is not sufficient if I know I have to make all my staff aware of it. And not only my staff, but also I have to educate my clients, form a study group of like-minded professionals to exchange ideas. This is what I wrote. Don't read books. When you may be very happy to note this, don't read books. Sorry, that is what we are doing. But the point I'm saying is, when I say don't read books, please read e-books. E-books which are there very wonderfully in the company's MCA website. If you go, there is an e-book on the company's e-act. Company e-act of Companies Act is there, which has colorfully arranged. In fact, the Institute of Company Secretaries, Dungarchandji, has taken the lead in making this particular e-book. I think our institute should take the lead in making income tax, GST, and all the stuff as colorful. GST is also now available as colorfully like in the Companies Act, but income tax I don't find in one place the e-book on Income Tax Act. I think Jaman George and the Dungarchandji, all the future Central Council members and the future presidents, please ensure that this mileage is taken so that our institute can get the lead. Send mailers to educate and forewarn the clients. Take a holistic view, just as we talked about tax and other laws. If there are any GST implication, that also we can provide. Then revise your strategy. Have exclusive company law desk headed by an in-house professional company secretary. Proper infrastructure facility. I mean, today we need to have a computer of a particular standard. Sometimes it will not go because the computer speed is not there or the RAM is not up to date. Ensure security of DSCs. when DSC today is a very important thing which is available. DSCs lying all around the office is akin to the blank signature on a stamp paper which is lying all around the office. Please take care of whatever precautions you use to take care for blank signatures, which we never used to do. But today, the people realize that don't realize that DSCs lying all around the office is as good as stamp paper signed documents lying all around the office. So please take precautions on that. Convert existing companies either to LLPs or partnership firms if the companies are not, the status is not required because the compliances are that much more. Desist business from entities to set up companies unless warranted. Increase fees charged proportionate to cost, risk and time spent. A piecemeal fee, when if you say that, I will do all the services and I will charge you 75,000 rupees per annum, you are actually cutting down on my fee, and also you are doing injustice to yourself. So please don't do that. Charge a piecemeal fee for every work, and that based on the time and efforts involved. The time is not the time of only the doing time. There is a lot of learning time. The 3 years of CA, the 3 years of practice, which the learning that I did should also be loaded onto the client. And beware of section 144 prohibited services. So with that, I come to the end. I'm sure, Dungachanji, I just want to ask one question before taking the questions. We are called practicing chartered accountants. We are called practicing chartered accountants. You see, ticks for company law practice. That's what I said. And then it is told that practice makes a man perfect. Now we are called, Jim and George, I want you on the screen if you are there.
No, for Gururaj, for a change, we have brought Panaraj sir here.
Oh, fantastic. Then I would love to see him. I would love to see him on the screen. Sir, please come on screen. I would like you to...
He's come on screen now, Gururaj.
Okay, I am not able to see him like I am able to see you. Maybe the focus should be shifted on to him.
You can stop sharing the screen. He'll be visible.
Oh, great. Okay, then I will do that for... Yeah. Yes, sir. Sir, so nice to see you. You're looking like a pilot. you are indeed a pilot as far as I am concerned. Ask this question that CAs are called as CAs in practice. And it is told that practice makes a man perfect. So therefore, we as chartered accountants in practice will never be perfect chartered accountants. We are only practicing chartered accountants. When will we be the perfect chartered accountants? What do you say, sir? When we considered as perfect chartered accountants? Is it that always we are playing a practice match and we are playing the real match, real Wimbledon, or we are just practicing day in and day out? What do you say, sir?
We should become perfect CS also.
We should become practice. I mean, I was just thinking about this particular thing. If we are only called as practicing chartered accountants, when will we become perfect? Is it because the MCA and the income tax are going every day a change, such that we are not in a position to become perfect, because they are ensuring that we don't become perfect because every day there is so much of amendment. So is that what is the practicing chartered accountant meaning? Then after great analysis, why great analysis? It's a simple analysis, I can tell you. If practice makes a man perfect is not the right analogy, there are two practices. One is to say practice makes a man perfect. That is PRACTISE, practice as a verb. Now practice what you preach. Practice what you preach. That means we chartered accountants don't only preach, we are actually practicing what we preach. I think the practicing chartered accountant is taught in that particular sense where we are very practical, not just theoretical, we are practical. So therefore, practicing chartered accountant is right to say that we just don't preach. We don't just teach like the teachers. We are actually doing our work along with teaching our clients and educating the clients. We are enabling them to perform their real duties. So that is how the practicing chartered accountant is considered to be the perfect chartered accountant always. So with that, I'm ready to take questions. And I also want to hear Panaraj at the end.
Yeah, we'll request Panara sir to speak after the questions are over.
Yes.
Yeah.
Yeah, the question is, sir, what are the rules that are applicable if a company gives an advance for work to be done by a person and it does not do the work and the amount is not received?
So this is not in relation to related party. It is in relation to deposits, which we covered earlier. Rules applicable if a company gives an advance for works to be done by a person and he does not work amount. So that means you have given the money. So neither of them will apply to you. Let us be very clear. Deposit applies only if you take the money. If you have given the money, then I am afraid that you will have to write it off as a bad debt in the books.
Is the condition that deposit is not out of borrowed funds applicable even for deposit from members?
Yes, sir. It is so. It is also applicable for a deposit from members. It is there in my slide presentation where I just went very fast on that particular account. It is applicable even for members. And very interestingly, let me tell you, I challenge this to everybody, every chartered accountant, that you must read the entire Companies Act and Companies Rules and tell me where it is told. If you keep 1:100 magnifying glass, you will be able to see this particular point. I mean, I have to do so much of analysis to do this particular. I mean, it is original analysis. What you will see there, taking a lot of my midnight oil and my family time. But then I wish that these things are given in the manner that I have presented. Otherwise, it is very difficult to say. It is told that, where it is told, where the application has to be collected. The larger heading is every company, when it is taking the members' deposit, should collect an application. And in that application, there must be an undertaking to say that it is not out of borrowed funds. So somewhere below in small print, they are given like that. That's the answer to the question.
A company gives a loan to its client company which is recoverable against the future supply bills. Does it amount to deposit?
Sir, we have to be very clear. Money taken only is deposit. Money given is a loan given. So you'll have to see from 185 perspective if it is given to a related party. Otherwise, it doesn't come under the purview of company law. You will have to see only if the other person taking should be worried about it, not the person giving.
Correct.
Deposit is there to protect. Let us be very clear. Deposit is there to protect the depositor. Okay. Now you are the depositor. The other person taking should worry about that, and of course be worried about your money when you are giving, because it may not come back. So to that extent, you should be worried. 180. I mean, 70 to 75 come there.
If the advance is lying in accounts for more than 365 days, just due to non-adjustment of invoice, like non-receipt of invoices, etc., shall be reported as deposits, lack of internal control from the company.
No, just due to non-adjustment of invoice, like non-receipt of invoice. It is not non-receipt of invoice. It is you have to generate the invoice. I mean, you have to generate the invoice because it is not received. You must be very clear. When you have received, you have to generate the invoice. Where is the question of receiving the invoice? Generate the invoice and give. So there is no respite. So you have to either get it, or I told you, if it is from a company, you can put it under the heading column number 6. Column number 6, where you say intercorporate deposits.
And next is regarding loan from shareholders, should it be passed in GM in advance or it has to be ratified by the subsequent GM?
188 is very clear, prior ordinary resolution. So which means ordinary resolutions before you do this particular act. If the act is done and then you approach them, they can deny that. And if it is denied, you will have to cancel that, and whatever benefit you have taken, you will have to be refunded. I said it is prior. However, they said it can be ratified within 3 months. I mean, within 3 months, they can ratify it.
Okay, next is if a customer advance could not be fully repaid within a period of 365 days due to COVID-19, will it be deemed that the company has accepted the deposit in respect of balance in customer advance, and will the penal consequences attract as per Section 76 capital A?
Sir, this I have made a personal representation from my office to the MCA to consider this point, because they have given a lot of relaxation. Even this should be relaxed more. Okay, so as it stands, it is not there. I want the institute also to make a recommendation from your side to say that this should also be relaxed. Having said that, I am very sure that if somebody because of COVID has not been able to repay this, he will not be levied penalty. And I'm very sure if he can prove that, because penalty is always with the show cause notice. So there is a good enough cause for you to defer it. But how long is the question? Maybe 6 months. depends on your going concernability or paying ability.
In case of contract for infrastructure project and amounts are held as security beyond 45 days from MSME, will such amount be considered as overdue under MSME?
The answer is yes.
Even security.
There is no relaxation. There is no relaxation whatsoever. You know, MSMED Act is a very cute act. You can read it in half an hour, less than half an hour. You just read it. There is no, it is a micro act in that sense. It's a micro act.
Okay, next question is challenging your perfection. Can the DPT3 figures and the audited accounts differ?
Challenge your perfection. What is that, sir? I didn't get it.
No. The question asked is DPT3 figures and the audited accounts differ?
Okay.
Which is challenging the perfection.
No. See, that is a challenge. That is a challenge. I said that you will have to file your DPT3 after you finalize your accounts. Whereas filing DPT3, 30th June is the last date. In fact, again, a representation has to go from our institute to say that the normal due date is 30th June. Please consider it as along with the balance sheet date so that once the balance sheet gets finalized, it could be completed. Especially the problem is if you have to give a DPT3 under the CS certificate. I told you all DPT3 need not be with the CS certificate. Now today you have given the CS certificate and thereafter you find that it is differing. That should definitely not happen. So once you have given, you should be very clear about that number, because once you have given a certificate, you cannot thereafter defer it in your audited financial statement. So therefore I say the due date should be shifted so that we are given enough time there.
If there is a counterclaim against the MSME, can the debtor withhold the payment?
Yes, sir. What is told is 45 days from the date of acceptance or deemed acceptance. Deemed acceptance means if within 15 days from the date of receiving the goods or services, if you have not objected about the deficiency in the goods or services, then it will be considered as accepted ab initio from the date of supply. So within 15 days from the date of supply, you have an option to inform him about the deficiency in the material or supply. In that context, you have not accepted the goods. So therefore, the 45 days comes from the date of acceptance or deemed acceptance.
Next is whether the loan obtained by director or his relative from bank or PFI should also not be lent by director or relative to the company.
Whether the loan obtained by director or his relative from bank or finance should also not be lent by the director or relative. Now, I told you, director or the relative of the director has to give an undertaking that it is not out of borrowed funds. So it looks like he's borrowed from the bank and giving it to the company. That also is not correct. Then they say that the company should have borrowed it from the bank. If you have borrowed it from the bank, it is not director's money. So the answer is what is permitted to be done by the company, if it is done by the director and then given to the company, is also considered as wrong.
Next is a company manufacturing and supplying capital goods and period of supply is more than 365 days. It takes an advance and has not started manufacture at all, even after 365 days. Will this be a deposit?
The answer is it will be considered as a deposit as long as you are supplying the goods. If you eventually don't supply the goods, then it will not be considered as under that particular category at all. It will be considered as a red deposit ab initio.
Regarding loan from shareholders, should it be passed in GM in advance or it has to be ratified by the subsequent GM? I think you answered this.
Yeah. Let me be clear. Loan from shareholders is not covered under 188. Now, all financial transactions are not covered under 188. Loan from shareholders means it comes as deposits. Not loan from shareholders is coming under deposits. So it is not coming under 188 transactions. So
transactions, correct. Next is fellow companies appointed as internal auditor. No comparative rates are obtained. Will it be at arm's length?
So this is a very challenging thing. How do you consider the services given by an internal auditor and say that it is comparable. This becomes a very challenging thing. So I always say, if you have a proper thing, you call it as arm's length. Otherwise, you get it approved through the board. That is the best thing that should have happened. Otherwise, somebody can challenge as to how do you say that it is at arm's length. So that could be a. So this is coming to office of profit. So this is exactly a case of services or office of profit. So please ensure that it is either at arm's length by whatever methodology, or if you have a doubt, then get it approved through the directors. If it is below the breach, below the breaching limit, if it is above that, get it approved by the company in the GM.
Next is remuneration to whole-time director to be reported under director's report, even there is no specific arrangement or agreement.
Remuneration, yes, sir. It is to be reported under the director's report, even under the financial statements. But director's remuneration is not a subject matter of 188. It comes under 197, 198, which has to be complied with. Anyway, that has to be going through the audit committee, board, and general body meeting.
What if the related party provides a service to a company at less than the arm's length price?
No problem. No problem. I mean, in my example, I said 1 lakh rupees is the rent, and the company is offering it at 75,000 rupees. I mean, the director is offering it at 75,000 rupees. So then there is no problem.
Where payments are made by a group entity, that is a related party for another company, and is reimbursed by other entity, is it required to disclose as RPT? It does not strictly fall within the RPT definition of section 1W.
I fully agree with that. If it is exactly that the company has incurred and it is only being paid, it doesn't fit into any of those 7 categories. So therefore, this is not coming under 180.
What about payments under cost sharing agreements? Is this covered under section 188?
If the cost sharing agreement is also very similar to, I think, the point, the company buys a software, one software, and it is very logically decided that, we used to do that in State Bank of India. State Bank of India used to buy all the softwares, and all the subsidiaries were charged 10% of that, 5%, depending on our turnovers, it was already decided. So if it is a cost sharing arrangement, instead of State Bank of Mysore paying it, State Bank of India is paying it and collecting it as a reimbursement. So it fits under that particular category.
Appointment to any office or place of profit in CSA. Director in A is made a consultant in B and gives consultancy to A in its professional capacity. Is it covered?
Yes, sir, it is covered. As long as that B is a company. I presume that B is a company.
Yeah, query number 47, I'm skipping because the delegate has said that it is a kind of answer. Next is, if there are only 2 directors, how to pass board resolution when one of them or both are interested in the resolution? If there are only 2 members in private company, is it necessary to take approval in GM even after board approval?
Sir, we have already seen this. As far as board meeting is concerned, I have told that interested directors not to participate. But if there are only 2 directors, then you will have to appoint some other director and get it approved. I mean, if it is a public company, if it is a private company, I told you there is no problem. The question of interested director does not apply to private limited company, either in the board or in the general body meeting. If it is a public company, the only way out is you will have to appoint somebody else as a director and get it approved. That is the practical way. Otherwise, theory of impossibility and get it approved. I would say that in that context, let there be a 3rd director appointed and he approves it. And if a board quorum is 2 members, then it should be for another 2 directors. That is another problem.
Can you please explain para 3C and para?
One thing is told that this exception of 90% is told for general body meeting and not for directors meeting. I think our institute under the CLCGS, Company Law and Corporate Governance Committee, or maybe SIRC also can write to the SIRC. I think we also have, SIRC also has a company law committee. So we can also represent to the MCA to say, even in the case of a public company, instead of getting a director appointed, if 90% rule, that means more than 90%, or if all the directors are interested. So if they're, let us say in a public limited company, only husband and wife are the directors, then it should pass and if it is a remuneration of the husband, so wife is also an interested director in that sense. So therefore, it should be allowed. That is one way. The other way to say is, if the husband is interested, the wife need not be interested, because they say only the concerned director should absent himself, or because he may also be related, or in any case. So therefore, in such a context, or if wife's remuneration is discussed, then husband can participate and wife need not participate. That is how it is. So therefore, having one more director will sort out the problem. But why have another director? Instead of that, our CLCGS or your committee can recommend to say, if all the directors are okay, then it should be okay. But then problem is, they may not approve this, to say, let it go to the general body meeting and let that decide. There also, if it is 90%, anyway 90% will is okay. Then nobody is cheated in that context. That's it.
Can you please explain para 3C and para E and para 21 and para 23 of AS 80? So many.
I think we should defer this question for when
Not
AS 18, we'll have to deal with that.
Correct. If a private limited company invested more than 50% of shares in LLP, this required consolidation of financial statements. I mean, will this require a consolidation of financial statements?
The answer is yes. The answer is yes. Our institute has told us very clearly that LLP is also a body corporate which has to be consolidated.
Okay. I think even if there are some questions, we won't be able to take up now because already we have reached by more than half an hour.
Yeah,
so
there's only one question. There is only one question. Should we just take that one question alone?
Yeah, then we can, Abhishek, we can.
Yeah. See, SS Nayak has asked, deposit accepted from franchisees with an agreement and normally repayable after 3 years cancellation of the franchise agreement. Whether such deposits need to be reported under section 73 to 76.
I'm very happy that SS Nayak from Bengaluru has asked this question. Yesterday I was with him in Bangalore, talking on tax audit. He's the chairman of the Bangalore branch. And I think he was not there at the beginning of my talk because he himself runs a television program every Sunday in Namakudla television channel. Today he was talking of the role of teachers in the nation building, a very good topic. He joined late, so therefore let me tell him, he's also a great inspirer for me. Let me tell Nayak that franchisee amount is collected as security deposit, and any security deposit will be considered as a green deposit. If Nayak does not understand what is green deposit, I'll have to tell him, because in the morning itself we talked about blue deposit, green deposits, and red deposits. So green deposits are exempted deposits. So security deposit collected from anybody without any time limit is considered as exempted deposit.
Abhishek, we're done with that. There are no more questions.
Yeah, Abhishek, you are suddenly not visible. You'll have to switch on your video.
I think he's doing a faceless assessment.
No, the problem is
faceless assessment.
when I'm switching on my video, it is getting disconnected because of my bandwidth. So that is why I'm avoiding it. I tried it 3-4 times, but it kept getting disconnected.
Panarad sir, you can share your thoughts and then we can close the session. Panarad sir, you'll have to unmute, sir. Panarad sir. Yes.
Unmuted and again forgot to now. So thank you for making me speak here today, because it is one of the most what's called happiest day for me to be part of this program when Mr. Gururaj Acharya is speaking, at least at SIRC level, because most of the audience would not be knowing that our association is from 80s. That is, he is also native of my place, that is Bellary in Karnataka, and I recollected the student days when I was teaching him in intermediate CA, both accountancy and cost accounting. At that time, when we were doing company accounts, we were having even company law with us. So the company law provisions and these things, this integrating the subjects was one of the special things which I thought was giving very satisfaction to me during those days.
Panarad sir, I must interrupt. The way he kind of, mixes all the other enactments, I have not seen any other speaker doing it. If they talk Companies Act, they'll only stick to Companies Act.
Yes.
He will take GST, income tax, and then give a proper mix of things so that we don't do mistakes.
Actually, I want to come to that, but it will not be very nice for the people to hear these words from me, because as a teacher or as a long associate, it should be seen as a biased opinion. But thank you for giving that opinion on behalf of Gururaj, because the amount of efforts that he does, the compassionate and comprehensive approach that he has is unbelievable, unbelievable. So I recollected those students' days from where I have been seeing him growing from strength to strength since those student days. To secure ranks both in CA and CW examination, then teaching in Bangalore for CA students at Bangalore branch, and he became a speaker. He was called a speaker on accounting standards initially. So from those days, I've been seeing him, never seen back, and every time he is improving on his presentation and his what's called comprehensive approach and lucidity in explaining the things. He would step into the shoes of the audience, and what are the doubts the audience would get, he himself will raise, which is a very special quality, and that quality he has from birth, I can say. He has that great inborn quality, and his passion to teach and speak is unbelievable. He invests lot of quality time. I mean every word here. He invests lot of quality time to prepare the slides. Whenever I visit his office in Bengaluru, when I go there, some slide would be there on the screen. I would ask him, what are these italics and what is this type of letter? What is the size of the letter and all these things? So many colors, so many strike-offs to recollect what was the earlier law and all these things. Unbelievable. And the meticulous observation that he makes is it is only Gururaj can match himself. No other person, as you rightly said. And he invest lot of that quality time to prepare those slides. And you would have observed these the charts, boxes, different colors, different fonts which is everything is meticulously crafted by him. I cannot use the word written. It is crafted. So he sits many times his morning workouts and sits on the system at as early as 5 a.m. till he is convinced himself that the presentation is good. And today morning, while joining this seminar, I wanted to see he had last seen WhatsApp message is 4:30 a.m. 4:20 or 4:30. I don't remember. So at 4:30, he sat here to convince himself that the things are right. So I am very, very happy to see him as one of the best and most sought after speakers in southern regional level now, from Bellary to southern region, a big leap, and I wish to see him grow from strength to strength. I can only conclude by using Shakespeare's quote, which I always use. Shakespeare says, it's always boon to be father of an overachieved son. It is always a boon to be father of an overachieved son, but it is a curse to be son of an overachieved father. So if you replace father to a teacher, and I am so happy that I am excelled by one of the proudest students of mine, and he would be one of the most precious assets of the CA Institute and CA fraternity. And these are the people who are the real pillars of our institute and who are the real assets of our institute, which I mean, because in partnership nation building is the quote of our institute. If at all we have to be partners, we should be well aware of all the provisions. And you could see the closing remarks that he made, how CA can excel other company secretaries, even in the area of company law practice. So for everything, he has substantiation, and he has, for most of it, statutory based called strength to substantiate his presentation. So I am amazed to know that on deposits and the related parties, can anyone speak for 3 hours? And it took more than 3 hours, and I never felt that I joined a bit late because of the technical problems. I never felt even 1 minute lost there, and last 1.5 hours, I felt just like 20-30 minutes the way he presented. Hats off to you, Mr. Gururaj Acharya, and I very heartfully thank you on behalf of the SIRC for the effort that you are making. God bless you. All the wishes of all the members across the South are there with you to excel in the future days. Also, we wish to see you in higher positions and in larger forums at international levels also in the future. And we only wish we keep learning from you. and you are one of the proudest students. Thank you very much.
In fact, sir, that's a perfect compliment from a guru to a shishya. In fact, I remember whenever I used to, initiate talks with Gururaj on any topic, it will not just end in 1 or 2 minutes. He will try to understand what is it I'm trying to do, what are the other topics, so that the perfect, the members what they need, they get it actually. So that's one quality. And coincidentally, he did mention that if possible, you can call CA Panaraj as a panelist. But since John George is the chairman of the corporate law committee, the protocol demanded that he be part of it. But nevertheless, I thought in the end, you can come and address so that, you share the, the memories and, how a shishya has today overtaken the guru actually. So thank you so much, Panaraj sir, for joining. Gururaj sir, if you want to add something.
No. I would never say the shishya will overtake the guru. Shishya will always carry the guru with him, and both of us will walk hand in hand.
That's it.
Which I go. And all that he has told, I will only say thank God. Krishnar Panamastu. I enjoyed the day as much as I'm sure all of you enjoyed the learning process, because I would call this as the learning process. Each one of us are learning. And I will always say thanks to Dungarchandji for giving me this excellent opportunity of getting to know some of the finer aspects, because it is not when I was taught, but when I was teaching that I learned a lot. So I learned a lot, in the process of teaching. So thank you so much for enabling me, because when you're addressing an August gathering like this, you will have to be more than well prepared. So thanks for giving me the opportunity to prepare. And I should only thank profusely my wife, who is sparing her family time
Yes.
for me to be with all of you. So thank you so much, and God bless all of you.
We also thank her for that.
Yeah, thank you so much. Thank you so much.
I should also thank your families, the learned leaders. All of them were the learned leaders. I mean, I am a learned person, but all of you are learned leaders. So your families also must have really, I'm sure they have sacrificed your time. I mean, they've allowed you to be here. So thanks to all the family members who have given the Sunday time for the profession. Thank you so much.
Thank you, Gururaj. Abhishek, over to you to formally propose the vote of thanks.
Yeah, thank you so much, Gururaj. Thoroughly wonderful presentation as always. We really enjoyed it. I also want to thank C.A. Panaraj sir, who has joined us. We had specially wanted to invite him, chairman had called, and both of us felt this is the second time Gururaj sir is speaking, so we should have Panaraj sir also with us. So we invited him to join, and he also very graciously last minute he accepted and joined today. So thank you, Panaraj sir. And of course, I'd like to thank our immediate past chairman, Jomon K. George. And I'll be remiss if I do not thank C. Gururaj Jain, our chairman of SIRC, for conceptualizing and planning this program today. It's a 3-day program, and we have successfully ended it with an excellent speaker and an excellent session. I thank all the participants who joined in such large numbers to participate in this and even encourage us with all your positive feedback. We request all of you to please do continue to share your feedback. The link has been shared in the chat window. So do share your feedback. We want to listen and make ourselves better. We always want to improve. So please do feel free to share your views. So thank you all for joining us. Please do join again tomorrow. We have a session at 6 p.m. on standards on auditing. So stay home, stay safe. Thank you, sir, Gururaj sir, and thank you all. Stay home, stay safe. Take care.
Yeah. Thanks, Abhishek, and one special thanks to CA Chinnsamy Ganesan, who kind of sketched the program in a nice way so that we all take benefit of it. Thank you all. And the PPTs and the materials will be uploaded in the website in short, in 2-3 days time. Thank you all of you.